Okay. Good evening, students. We started in the last class with the topic transfer pricing. We understood in that topic various methods of charging transfer price by one division to the other. What are the objectives of transfer price? That also we understood. All of you are aware that gold congruence is at the base when the transfer price is determined. That means when one division transfers its output to the other division buys that output as a raw material, then the transfer price should be finalized in such a way that both the divisions are in a position to have a very important decide to take first. Both the questions were around the same point, and that is when do we take into account the opportunity cost for deciding the minimum transfer price. Now please understand, minimum transfer price is from the point of view of transferring division. The transferring division is the selling division. So selling division will ensure that output is transferred at minimum price of rupees so and so. So minimum transfer price is always looked at by the selling division, whereas maximum transfer price is always from the point of view of buying division. So buying division will not be in a position to pay to the selling division anything beyond that transfer price. So maximum transfer price is for the buying division, minimum transfer price is for the selling division. Not only that, while deciding the minimum transfer price, the selling division will recover its total cost, right? It could recover its variable cost or total cost, but more than that, it will recover the profit margin also, and profit margin in terms of opportunity cost. So the formula which we had understood while deciding the minimum transfer price is marginal cost of selling, marginal cost, that is variable cost of selling division per unit, plus opportunity cost. Now the question asked by two students was, sir, do we take into account opportunity cost every time or only when the capacity is full? Yes, I had mentioned this in the last class. I repeat again, whenever the selling division's capacity is full, capacity here is production capacity. When production capacity is full, that means there is 100% demand for the finished product in the market. Obviously, selling division would not like to patronize the internal customer. Selling division would not like to patronize the internal customer when its capacity is full. So that time it will recover opportunity cost as well from the buying division. So selling division will charge opportunity cost to buying division in case its capacity is full and there is 100% demand for its product in the external market. But whenever there is an excess capacity or whenever there is a surplus capacity, what we call idle capacity of selling division, all three words are one and the same. Excess capacity, surplus capacity or idle capacity, right, of selling division. Obviously selling division would like to recover only marginal cost. There is no question of opportunity cost at all because there is no demand for its products in the external market. Right? So it's so simple. I gave you the example of a professional also, any consultant, any professional. If my hands are full, if I am fully occupied for all the time throughout the month, and if there is any special assignment to be undertaken, obviously I would like to reject that assignment because my hands are full. I don't have any surplus time to cater to that special assignment. But still, if that special assignment has to be accepted, for whatever reason, maybe for factors because of the relations with that party, I may have to accept that special assignment. Obviously, what price I charge to that customer for that special assignment would be not only my marginal cost, but also the opportunity cost. Opportunity cost is nothing but the amount of benefit which the selling division would sacrifice, amount of profit which selling division would sacrifice or forgo by accepting the order of this customer. That means in normal course, had selling division catered to the market, it would have earned a contribution of something, few lakhs from the market. Now because those hours are diverted from the market demand to the internal customer, because those many hours are diverted from market demand to the internal customer, obviously we will have to recover, the selling division will have to recover from the internal customer the opportunity cost, that is amount of contribution lost or deprived of by not catering to the market. So logic is very simple. You can understand like this: when capacity is full, that means 100% capacity of the selling division is being utilized. Obviously, it will charge to the buying division marginal cost plus opportunity cost. And when capacity is excess or charge only marginal cost. So I think the questions asked by both the students around the same point are now clarified. Still, if you have any question, you can ask it in the link. We continue doing two cases in today's class on transfer pricing. Case number 1 we have already covered in the last class, and these questions had emerged out of that case. So now we look into case number 2 and 3. First we take case study number 3, which is easy to understand for all of you and which will lead to hello.
नहीं
Hello. Hello. Is this pretty visible? Yeah. Continue. Continue. Yeah. So I will read the case study very slowly. APC Limited has two divisions, Division X and Division Y, with full profit responsibility. Division X produces components JEX, which is supplied to both Division Y and external customer. So remember the name of the component, GEX, JEX. This is supplied to both Division Y and external customers. Now we look at Division Y's component. Division Y produces a product called Jextin, which incorporates component X. For 1 unit of Jextin, 2 units of component JEX and other material are used. Right? This is very important piece of information, that for manufacturing 1 unit of finished product, Division Y requires 2 units of the component. Right? And component is another thing you need to remember is Division Y has always bought component JEX from Division X at rupees 50 per unit. Since the lowest price at which component JEX could have been bought by Division Y is by Division Y was rupees 52 per unit. Division X charges the same price for component JEX. Yeah, I'll just adjust this. Remove the hotspot there. Remove the hotspot there. Keep it here. Remove the hotspot from there. Disconnected. The the disconnect. From there, you disconnect.
Disconnect
Till that. Okay, I start from the beginning. Company has two divisions, Division X and Division Y. Division X produces component X, which is supplied to both Division Y and external customers. And Division Y produces product called Jextin, which incorporates component Jex. For 1 unit of Jextin, 2 units of component Jex and other material are used. That means this is the point of importance, and this point I am highlighting. When 1 unit of finished product is being manufactured, obviously at that time 2 units of raw material will be used. So this highlighting, and therefore every number will have to be doubled. For every 1 unit of finished product, 2 units of components are used. Division Y has always bought component Jex from Division X at rupees 50 per unit. So that has been the transfer price all these years. Since the lowest price at which component Jex could have been bought by Division Y was rupees 52 per unit. So in the market, this product was available at rupees 52, and therefore Division Y never wanted to buy this product from the market. All the time it has been buying from the internal supplier, that is Division X, at rupees 50 only, 50 per unit. So that's a good thing. Now Division X charges the same price for component Jex to both Division Y and external customer. So as far as Division X is concerned, same price is being charged to external customer as well as internal customer. But when it comes to the buying division, that is the Division Y, it is procuring from Division X at 50 only, because all other suppliers are charging 52. That is how the business dynamics. However, it does not incur selling and distribution cost when transferring internally. Obviously, we all understand whenever the selling division transfers anything internally, it doesn't have to incur selling and distribution cost. Probably that is the reason why it is able to sell at 50 rupees, because it doesn't charge any sale distribution cost to the internal customer. Division Y has received a proposal from a new supplier who has Division Y has received a proposal from a new supplier who has offered to supply the component Jex for rupees 47 per unit, at least for next 3 years. Now, so far things were going on very smoothly. There was no issue. But suddenly, Division Y received another offer from one of the supplier who is now ready to supply at 47 rupees, and that too for next 3 years. Now, obviously, it's a very lucrative offer as far as Division Y is concerned, because 47 rupees में item मिल रहा है. Why to buy from the internal supplier, that is Division X, at rupees 50? Keep these figures at the back of your mind. Why to buy from internal supplier at rupees 50 when the outside supplier is supplying it at rupees 47? So manager of Division Y requests the manager of Division X to supply the component Jex at or below rupees 47 per unit. Now manager of Division X is not ready to reduce the transfer price, since divisional performance evaluation is done based on profit margin ratio of the division. All of you are aware of this typical conflict situation or tutu meme situation, where Division X is reluctant to charge anything below rupees 50, right? For the only reason that it would not like to incur a loss. And number 2, Division X manager's profitability is evaluated on the basis of the profitability of that division, and therefore performance evaluation and performance linked bonus purpose, at least Division X manager is not interested in selling or transferring internally to a price below rupees 50. 47 rupees out of question, out of consideration. That is the thought process of Division X, and therefore Division X manager straight away has refused. Right? Now the question arises, whenever there is a conflict, Division Y manager wants this to be transferred at 47, not at 50. Division X manager is reluctant to transfer at 47. Some cost data is given to you, so following additional information is made available to you. You are given the component Jex and product Jextin. Purposely I have used the word component because it is a raw material, and this is the product, that is the finished product. So Division X is supplying this component to Division Y. Division Y is manufacturing Jextin out of this and selling it in the external market. So all of you by this time understood the business model. Now we look at the selling price. Selling price is 50, 180. Then we look at less variable cost, direct material. See, component Jex it is given as buy-in price. Component X is a buy-in price. Buy-in price is internal transfer price or purchase price for division Y, and for manufacturing Jextin. So that is 100 rupees. Why 100 rupees? Actually the price is 50 rupees, but you understand 50 rupees for manufacturing, that is for manufacturing 1 unit of finished product, 2 units for manufacturing 1 unit of finished product, 2 units of raw materials are required. So obviously 1 unit of Jextin will require 2 units of Jex, and 1 unit of Jex costs 50 rupees for division Y, and therefore 50 rupees into 2, that is how 100 rupees. Please understand this 100 rupees and be mature to understand why 100. Actually it is 50. 50 rupees per unit is the price of Jex. But 2 units of Jex are supplied to manufacture 1 unit of Jextin, and therefore 100. Okay. Other materials 12 and 22, direct labor 16, 13, manufacturing overheads 2 and 5. So all this data is given. Selling and distribution cost 4 and 2, and contribution per unit is 16 and 38. Now let us see how 16 and 38 is arrived at. Let's see whether 16 and 38 calculated is correct or not. This is already calculated in the original case study itself. You can see 12. Just go on adding these figures. So I am annotating the figures. You go on adding the figures. 12 rupees plus 16 rupees plus 2 rupees manufacturing overhead plus 4 rupees. So you have 16 plus 12, that is 28 plus 2, 30 plus 4, 34. So 34 rupees when you deduct from the selling price, and selling price you have seen is 50. So 50 minus 34 is contribution per unit. It is 16. Contribution per unit is 16. So all of you understood how this 16 is arrived at. 50 rupees is the selling price of Jex, and minus total variable cost 12 plus 16, 28 plus 2, 30 plus 4, 34. So 50 minus 34 is 16. That is contribution per unit. Now let us calculate contribution per unit for division Y. Division Y is selling this product in the market, and the cost given is 100. Now this is 100, you all are aware. 50 into 2, that is 100. Then 22, then you have 13 direct labor, then 5 manufacturing overheads. So, if you look at, I'll share the video. So all of you are able to see this. Total price is 180, and 180 minus 142, that is what is 38. So contribution per unit is 38. So all of you are able to understand this calculation. 180 is the selling price minus 142 is the total variable cost. So 180 minus 142, 38 is the contribution per unit. Annual fixed cost is given as 40 lakh and 20 lakh. First column is X and second column is Y. Annual external demand is 3 lakh units for X and 1,20,000 units for Y. So you have annual demand for the product. For X, demand is 3 lakh, and for Y, it is 1,20,000. Capacity of the plant is 5 lakh. So that means for X, that is The first division, which is manufacturing this component checks, the capacity is to manufacture 5 lakh units. And here capacity is to manufacture 1,50,000 units. Now, so for the final demand, the demand for finished product of Jextin is 1,20,000. You have seen this demand? I'll scroll down. Demand for finished product is 1,20,000 units, and for manufacturing 1,20,000 units, 2 units are required. So 2,40,000 units of raw material required. So internal customer requires 2,40,000 and external demand is 3 lakh. I'm talking about division X. Division X has capacity to manufacture 5 lakh units. And 5 lakh units, how do you cater? The requirement is 5,40,000 units. How it is 5,40,000? Please understand again. 1,20,000 multiplied by 2 units. So 2,40,000 units required by the internal customer, and 3 lakh units required by the external customer for division X. 3 lakh units required by external customer and 2,40,000 units required by internal customer. So demand is 5,40,000 and capacity of the plant is just 5 lakh. So you can understand a typical scenario where the hands are full, there is no excess capacity. In fact, capacity is falling short. So what division X will have to do is first cater to the internal customer. That means division X will have to first cater to internal customer by supplying 2,40,000 units. And balance 2,60,000 units will have to be supplied in the market. That is to cater to the external demand. So 3 lakh का external demand है. Once again understand, उसमें से you can fulfill only requirement or demand of 2,60,000 only. ये 2,60,000 कैसे आया? 1,20,000 multiplied by 2. So 2,40,000 will be sold internally. And 5 lakh minus 2,40,000, the balancing figure is 2,60,000, which will be sold to the external customer. So this will be the present scenario. This will be the present situation. Now I have not yet read the requirements of the question. I'm just talking to you very loudly only in terms of what do we understand from this given case data. I have not yet read the requirements of the question. I have just read the contents, and I think by this time all of you are familiar with the content. Division X and Division Y. Division X is manufacturing a product JEX, a component JEX, whereas Division Y is manufacturing a finished product Jextin. And 1 unit of finished product requires 2 units of raw material. And till now, Division Y has been procuring this item from Division X only at 50 rupees because all over in market it was being supplied at 52. Now Division X has been supplying this product, this component, not only to Division Y but also to external customers. But now what has happened is Division Y has now received a proposal. See, so far things are going on smoothly, but now Division Y has received a proposal for supply of the same component at 47 rupees from the market. And that is why the whole brainstorming, whole deliberation, and we are talking about the conflict, right? Because now suddenly there is a market supplier who is ready to supply at 47. All these years I have been procuring as division Y manager, I have been procuring at 50 from my internal supplier. Now there is an outside supplier who is supplying at 47. So I am more comfortable with the external supplier. So now my bargaining position as division manager Y, my bargaining position increases. And therefore I will insist on division X manager to reduce the internal transfer price from 50 rupees to 47 rupees. Obviously division X manager is not going to listen to my request for the only reason that performance of his division will be adversely affected. If he reduces the transfer price from 50 rupees to 47 rupees, his performance will be affected and then his bonus will be affected. He will have to suffer in terms of his performance linked incentive or bonus. So he will not be ready to reduce the price from 50 to 47. Yeah? So selling and distribution cost of 4 rupees is not included. Selling and distribution cost of 4 rupees is not included in that 50 rupees price charged to the internal customer. Because to internal customer we never charge selling and distribution cost. So after reading the problem, now let us look at the requirement of the question. We have read the question, we have read between the lines, and we know that the today's business model is you are required to supply 1,20,000 units in the market, finished product, division Y manager. So he requires 2,40,000 units of component internally. So out of 5 lakh capacity of the plant, division X can cater to the internal customer 2,40,000 units, and balance 2,60,000 units will have to be supplied in the market. So breakup of 5 lakh is 260 to the external customer and 240 to the internal customer. So first question is calculate the present profit of each division and the company as a whole. Right? Presently, this is the scenario that it will supply 2,40,000. I told you repeatedly, I am quoting these figures so they remain at the back of mind. At present, the division X will supply 2,40,000 units to division Y and 2,60,000 units externally in the market. So breakup is 240 internally and 260 externally. So at this present situation, what is the profit of each division and the company as a whole? This is question number 1. Let us look at question number 2. Analyze the impact of total annual profit of each division and the company as a whole if division Y accepts the offer of the new supplier. Now new supplier is ready to charge a price of 47 rupees. So therefore, if 47 rupees offer price is accepted by division Y, what will be the impact on annual profit of each division and a company as a whole? That is the proposal. So proposed scenario. Part 1 is the present scenario. Part 2 is proposed scenario. And the third one, in the change scenario, discuss why the top management should intervene and advise a suitable transfer price for component checks for resolving transfer pricing conflict, which promotes goal congruence through efficient performance of the concerned division. I think this is very self-explanatory. Top management will have to intervene and will have to advise a suitable transfer price, because if division Y is adamant, if division Y manager is rigid, and if he says that I will procure this from the external supplier at rupees 47 rupees, then probably division X capacity may remain underutilized. Division X capacity may not be fully utilized. Today, Division X capacity is fully utilized because it is catering to both external market and internal customer. But if tomorrow Division Y stops taking from Division X, then obviously Division X will not have any much scope to use its capacity fully, and therefore division X will be without, it will in fact have idle capacity or without any much of demand for its product. So that cannot be allowed, because company as a whole will suffer a loss. Company as a whole will suffer a loss. So top management will have to intervene. Here itself we can discuss why top management should intervene. Top management should intervene in the interest of the company as a whole, right? And he should advise a suitable transfer price. If not 47, at least something slightly maybe higher than 47 or something, but from 50 rupees present price, Division X will have to reduce its transfer price to some negotiable amount, negotiable rate, so that both the managers' egos are satisfied, and more than the ego, it is the profitability of the company as a whole. And that is what is the So just to remind all the students, this is the concept of goal congruence which we have to keep in mind while setting the transfer price. So three scenarios you have to respond. Scenario 1 is the present scenario, that is the current situation, that is present, that you have to discuss. Then scenario 2 is proposed, that is he accepts the offer. So new offer, that is proposed scenario. And scenario number 3, which is management intervention and advising a suitable the solution or the approach which is given below. The solution or the approach is given. Please try to understand, and if any doubt in any of the figures or calculations, you can ask. Profitability of each division and a company as a whole when Division X supplies 240,000 units of checks annually to Division Y. All of you are aware that Division Y produces 120,000 units of Jextin, and each component of Jextin requires 2 components of checks, that is currently procured from Division X, and 240,000 units of checks from Division X annually, right? You don't have to go through these lengthy sentences. Only understand 1,20,000 units of finished product manufacture करने के लिए 2,40,000 units of components are required. So 2,40,000 will be procured from internal supplier. Division X has an overall capacity of 5 lakh units annually to produce checks. Out of this, it produces 2,40,000 for Division Y, and it must first cater to, that is most important, which it must first cater to. I am highlighting this. Division Y, it must first cater to its requirements. This I am highlighting, because internal customer always first. This is the point to be highlighted. So Division Y, which it first must cater to. So out of 5 lakh capacity, 2,40,000 will be supplied to internal customer and remaining 2,60,000 units objects will be supplied to the external customer. So this commentary or this preamble, what I call preamble or an introduction, that is required to prove our table. In the table, I have drawn two columns. One is supply by X division X internally, and internal supply is 2,40,000 units. And second column is supply to external customer, which is 2,60,000. But before that, you must understand ये 2,40,000 आया कहाँ से? It is 1,20,000 multiplied by 2. That is by 2,40,000. And 2,60,000 is the balancing figure, which is total capacity 5 lakh minus 2,40,000. All this is expressed in narrative form. You can show it in the form of workings also if you are more comfortable. But in the narrative form, I have expressed so that you can understand while preparing for the exam. Now let us understand the profitability statement at the current scenario. So we have divisional and overall profitability of APC. Now because the table has to be fitted in one screen, obviously the font size is low, low, and you will have to understand from this. Yeah? So please understand, I am reading slowly one by one. Each cell, division X has got two columns, external cells, I am highlighting here, and then internal cells. One is external cells and other one is internal cells. How much is external cells? 2,60,000 units. How much is internal cells? That is 2,40,000 units. Internal cells is to an internal customer, 2,40,000. So totally 5 lakh units you are supplying. Yeah? Now we go by the per unit column, and there is also a column for division Y, which is external cells. And external cell is 1,20,000 unit. We'll come to division Y's profitability later on. First look at division X profitability, because that is most important to understand. It is a supplying division. Yeah? Understand like this. It is worked out on per unit column and totality column also. So selling price is 50 rupees. Now I am not showing you the calculations for totality, because that is simple multiplication. 50 rupees selling price multiplied by 2,60,000 units, 26 5s are 130. All are finance students and therefore understand 130 lakhs. 130 lakhs. Similarly, 2,40,000 units and 22,40,000 units multiplied by 50, that will give 1 lakh, that will give 120 lakhs. 120 lakh is internal cell. So on totality basis, you did not worry about the calculations, because that you can fill up the cell. You can fill up the cells or fill up the columns on your own. I'm more worried about or more concentrating on the per unit column. So selling price is 50 rupees minus variable cost. Obviously material cost is 12, direct labor is 16. This is all for division X. Manufacturing overhead is 2 and selling and distribution overhead is 4. So we had seen 34 rupees is the total variable cost. This we had understood. If you add these figures 12, 16, 2 and 4, I had showed you in the question. So once again I highlight this. You can take this. 12 rupees is the material cost, other material. 16 rupees is labor cost. 2 rupees is manufacturing overheads, and selling and distribution cost is 4 rupees. So you add these four figures, 12 plus 16, 28 plus 2, 30 plus 4, 34. So 34 rupees is the total variable cost. And if you deduct from 50 rupees selling price 34 rupees, your contribution comes to 16 rupees. Now 16 rupees is the contribution per unit. Now straight away you can multiply contribution per unit by number of units. So 16 rupees multiplied by 2,60,000, 16 rupees multiplied by 2,60,000, you will get 41,60,000. Just do it on the calculator and see whether you are getting 16 rupees multiplied by 2,60,000, because external customer you are supplying 2,60,000 units. So 2,60,000 units into per unit contribution of 16. So 41,60,000 is the total contribution from external cells. Abhi internal cell dekho. Internal cell is 2,40,000 units. That is what we had written. 1,20,000 multiplied by 2. So 2,40,000 units you are selling internally. And please understand, selling and distribution overheads of 4, you are not recovering to internal customer. This 4 rupees selling and distribution overheads you are not recovering. And therefore there is a dash over here. We are not recovering 4 rupees over here from the internal customer. So it is 12 plus 16, 28 plus 2, 30. That's all. So 30 rupees is our total variable cost, and 50 rupees minus 30 rupees. So 20 rupees is the contribution per unit. 50 rupees minus 30 rupees is the variable cost. 30 रुपया कहां से आया? 12, 16 और 2 इंटरनल कस्टमर का कंट्रीब्यूशन कैलकुलेट करने के टाइम 4 रुपया पकड़ना नहीं है, इसके लिए मैंने क्रॉस मारा. Selling and distribution overheads are not charged to the internal customer, and therefore our answer is 50 minus 30, that is 20. Contribution per unit is 20 multiplied by 2,40,000 units, so total contribution is 48 lakhs. Now all of you can read this figure. 48 lakhs is the total contribution. Yeah? So division makes in contribution of 41 lakh 60,000 from external sales and 48 lakh contribution from internal sales. I think these figures are self-explanatory. Now we look at for division. This is total for division X. So total is also taken for division X. You can see 4160 plus 48, that is 89 lakh 60,000 is the total contribution for division X. Fixed cost we are going to deduct later on and get the profit. So ultimately fixed cost will be divided, that data is given and we get the profit. I'll scroll the screen down slightly later. Let us understand the external, the sale of finished product by division Y. All this was division X. Now let us look at division Y. Division Y has the external demand of 1,20,000 units. Multiplied by selling price of 180. Now look at this price structure is different. Now it is 180. So you are considered 180. So 180 into 1,20,000 to 216 lakhs. If you multiply, you will get this figure. Straight away you can look at the variable cost. Variable cost is direct material. Now component checks is 100 rupees. Why 100 rupees? Because 50 rupees per unit is the charge, but 2 units of raw material are required and therefore 100 rupees. Then we have 20 rupees is other material, 30 rupees direct labor, then manufacturing overhead 5 and selling and distribution overhead 2. If you add all these figures, I had shown you, if you add all these figures from 100 rupees to 2 rupees, if you add all these figures, you will get the total variable cost of 142. So 100 plus 22, 122 plus 13, 135 plus 5, 140 plus 2, 142. So your total variable cost is 142. And you subtract 142 variable cost from selling price of 180, you get contribution of 38 rupees for division Y. 38 rupees contribution multiplied by external sales 1,20,000 will give you total contribution of 45 lakh 60,000. You can do the calculations on the calculator. 45 lakh 60,000. ये multiply करना है. 38 rupees is the contribution for division Y multiplied by 1,20,000 units. So you get total contribution of 45 lakh 60. And if you add 4560 plus 8960 for division X, company's overall contribution is 13520. This is the overall contribution for the company. If you add the figures, you will get this. 4560 plus 8960. Right? If all of you have understood this calculation, most important calculations, here 2 points to be remembered. Selling and distribution costs are not charged to the internal customer. So when division X is selling the finished product to division Y, obviously at that time division X will not charge selling and distribution costs. Point number 1 to internal customer. And point number 2, you will have to take into account 2 units of raw material required for 1 unit of finished product. So that means 50 rupees ki jagah you will be taking 100 rupees. These are the 2 key points in this particular calculation. Right? So please concentrate only on these 2 points. Rest all is arithmetic multiplication. That's it. And the addition. Arithmetic multiplication and the addition. So इधर 50 की जगह आपको 100 लेना है, because for 1 unit of finished product 2 units of component is required, and 1 unit of component costs 50 rupees internal price. So 2 units of component will require 100 rupees, and 4 rupees is not to be charged to internal customer. These 2 points you must remember in this particular example, in this particular part of the calculation. So I move now down further. Having understood this table, let us move down. We deduct fixed cost, right, from totality. Annual fixed costs are 40 lakhs and 20 lakhs. So annual fixed costs are 60 lakhs, 40 lakhs and 20 lakhs. We reduce from this total contribution and we get profit of 49 lakh 60,000 and 25 lakh 60,000. And for the company as a whole, 75 lakh 20,000. This is the current scenario. you can make out the current profit made by the company is 75,20,000. You can highlight this because later on when we are commenting or giving our narrative comments or analytical comments, it will be very easy and handy for us to quote this figure. So this is total profitability for the company. Now, some explanatory notes are given. Division X does not incur marketing cost on internal sales and therefore cost not incurred on transfer of 2,40,000 units to Division Y, which I explained to you, but it is given categorically by way of a note. So we have finished for answering first part of the question, and that is in the present scenario where 2,40,000 units are supplied internally and 2,60,000 units are supplied externally. This is how 5 lakh capacity is made use of. What is the profitability for the division and for the company? In this process, division X makes profit of 4960 and division Y makes profit of 2560, and total company as a whole makes profit of 7520. These are the three figures which should linger at the back of your mind. Now we go to scenario 2. In scenario 2, if you recollect, what was discussed was what is the impact on the profitability of each division and the company as a whole if the offer of the external supplier is accepted. Now division Y ultimately will look at from the point of view of its own profitability. Division Y's manager will look at from the point of view of profitability of its own division. So therefore he will be tempted by offer price of 47. 50 रुपए में इंटरनल कस्टमर से क्यों परचेस करूं? Why, if I am a division Y manager, I will think like this. Why should I procure from my internal customer at 50, internal supplier at 50 rupees when the same component is available in the market now from a new supplier at 47 rupees? So now what is the impact on profitability? All the calculations will remain the same, but with a slight change, variation now, and that is what we will understand. So look at this table. Now the market dynamics had changed. So division X now is in a position to supply only to external customer, and that is 3 lakh units. And internal sales is 0. Why? Because internally division Y is not buying from division X. Division Y is procuring from an external supplier at rupees 47. So as far as division X is concerned, its internal sale is 0. See, look at this irony. 5 lakh is the capacity of division X. 5 lakh units is the capacity of division X. But division X is in a position to supply only 3 lakh units in the market. That means capacity is underutilized. There is an excess capacity, surplus capacity, idle capacity with division X. Right? So when division Y stops procuring from division X capacity will suddenly become excess. Now probably all of you understand why top management all the more will have to intervene in this situation and ensure that division X also picks up in terms of its internal transfer. So that means it will have to reduce its price, transfer price from present 50 rupees to some reasonable level so that it will result in win-win situation. But that we'll think in the third part. In the second part we say what happens if these are sensitivity analysis. sell 1,20,000 units in the external market, whereas division X will sell 3 lakh units in the external market and nothing to the internal customer. So all our unit selling price remains the same. 50 rupees is the same price of division X. Let us concentrate on division X first. Where selling price is 50 minus material cost 12, direct labor 16, manufacturing overhead 2, and selling and distribution overhead 4. Now by this time all figures are in your mind. So if you add the 4 figures of variable cost, it is 34 rupees and contribution is 16 rupees. So 16 rupees contribution multiplied by 3 lakh unit. Directly also one can do. If you don't want to show in the form of a table, you can show directly also. But what happens if we lose sight of one of the figures? Then probably our calculations may go wrong. So I will never advise you to do these calculations directly. Better to show in the tabular form, better to show in the columnar form, tabular form or columnar form. So 3 lakh units multiplied by 16 rupees contribution. So 48 lakh will be the total contribution, right, made by division X. Straightforward calculation, 16 rupees per unit contribution, and now you are selling only to the external market, nothing to internal customer. So obviously you will charge say 4 rupees selling and distribution cost also, and 48 lakh will be the contribution, total contribution. If you now look at this, division Y will have selling price of 180 and 180 rupees selling price minus variable cost component checks will be 94. Again, please try to understand why 94. 94 is 47 multiplied by 2. 47 multiplied by 2. That is 94. All of you understand very well. 47 multiplied by 2, 94. Because 1 unit of finished product requires 2 units of raw material. So just as we did 50 into 200, similarly 47 into 2, 94. And other costs, variable costs remain the same, 22, 13, 5 and 2. All these things remain the same. And therefore total is 136. 136, now this figure has undergone change. So if you add all these figures, 94, 22, 13, 5 and 2, then your answer is 136. And 180 minus 136, it is 44. So 44 rupees is the contribution, and multiplied by external sale 1,20,000 units. So 44 rupees, this also you can do directly without showing the table. But I will always recommend, or I will always advise all the students to draw the table or prepare a chart like this so that you don't lose sight of any component of cost. You don't lose sight of any element of cost. That is the objective. So 44 rupees multiplied by 1,20,000 units, you get 52,80,000. That will be the total contribution. And 50 minus 20 lakh fixed cost will give you total profit of 32,80,000. Now this is profit of division Y, and 8 lakhs is the profit of division X. So ultimately total profitability for the company has reduced drastically to 40,80,000. Now all of you can understand, look at the table above. The profitability earlier was 75,20,000. We had highlighted 75,20,000 was the profit, and that is reduced to 40,80,000. Now this is a drastic reduction in profit. So now we analyze what has gone wrong. In the second part, you are asked to calculate what is the impact on profitability of the division and profitability of the company as a whole if the external offer price of 47 rupees is considered. If external offer price of 47 rupees is considered, then external supplier's price of 47 is considered. What is the impact on total profit for the company? Immediate response is total profit for the company has come down from 75,20,000 to 40,80,000. How it is this, and what are the factors responsible for this? Let us analyze. CA final students are expected to analyze the given data, the impact particularly. The impact itself has to be analyzed, and that breakup of that impact will have to be given. Breakup of the impact will have to be given. So I am reading out the analysis of the company. So this is continuation of the second part itself. When you accept the offer of external supplier at rupees 47 per unit, that means 2 units के लिए 94 rupees. So overall profit for the company has reduced from 75,20,000 per annum to 40,80,000 per annum. And the reduction in profit is therefore 34,40,000. Itna reduction ho gaya. 34,40,000 per annum is the reduction in profit. Now what are the reasons? You are supposed to analyze the reasons. There are 2 factors responsible for this. So I'm pushing it on the next page so that both you can see together. I'll push down on the next page. So it is easy for you to look at together the overall impact. So 34 lakh 40,000 is the reduction in. What are the factors responsible? Number one, cost of manufacturing this component is only rupees 30 per unit, whereas division Y is procuring this at 47. Actually देखा जाए तो internal cost of manufacturing is only 30 rupees and cost of procurement is 47. So don't you feel that 17 rupees extra division Y is spending on buying from the external market? So obviously that results in loss. Now how did you get this 30 rupees? This 30 rupees is the variable cost of manufacturing the component. Let us look at these figures. 30 rupees. 30 rupees का breakup ये है देखो. 12 रुपया that is other material, 16 रुपया direct labor, and you have 2 rupees manufacturing overhead, selling and distribution 30. So 30 rupees is the internal manufacturing cost of component JEX by division X. Internal manufacturing cost is only 30 rupees. Then division Y is procuring it from the market at 47 rupees. So 17 rupees extra, my goodness, it is paying for how many units? For 2,40,000 units of checks. Because market demand is 1,20,000. So it requires 2,40,000 units of component. So 2,40,000 units of component multiplied by 17 rupees extra. That it results in loss of 40,80,000. You all understood why there is so much of loss. 40,80,000 का loss तो इधर ही पकड़ा गया. We are doing a reconciliation. In fact, we are showing a reconciliation of this 34,40,000. The net loss is 34,40,000. The overall profitability of the company has reduced from 75,20,000 to 40,80,000. First cause or first factor responsible for decline in the profitability is procuring this component from the market at unusual price, a very high price of 47, when internal cost of manufacturing is only 30. So 47 ki jagah 30 rupees, make versus buy. In marginal costing, you always make this decision, make versus buy. If I make the component in-house, it is 30 rupees. If you buy from the market, it is 47. So unnecessarily company is spending 17 rupees extra for 2,40,000 units. That is 40,80,000 units. That is one reason. And second factor is a profit. It is no longer a loss. But that profit gets settled off or net off against the loss. Since division X no longer makes checks for internal sales, it can ramp up its external sales to meet the full annual demand of 3 lakh units. You saw in the first scenario when it was supplying only 2,60,000 units to external customer. Dividend X क्या कर रहा था? Internal customer को cater कर रहा था. 2,40,000 unit internal customer को दे रहा था. So obviously it was left with an additional capacity of only 2,40,000, 2,60,000, and therefore it was supplying to external customer only 2,60,000. Internal customer. Hello? Yes. Okay. All of you can see the screen. The company has made a loss of 34,40,000 rupees. And how is this loss? That is computed in this table. This table, if you see, there is a loss. I had shown you this table. You can have a look at this table again. Division X and division Y. Division X sells to external customers 3 lakh units and it sells to internal customer 0 units. Because now in second scenario, division Y is not ready to buy from division X. Division Y wants to buy from external market, external supplier at 47 rupees only, right? And therefore internal sale is 0. देखो division X का sale, internal sale कम हो गया, right? So now it is catering only to the external market and that is 3 lakh units when capacity is to produce 5 lakh units. So going by all these figures which remain the same, 12 rupees, 16 rupees, 2 rupees and 4 rupees. So 34 rupees is the variable cost and 16 rupees is the contribution. So 60, I told you directly also you can do 16 rupees contribution multiplied by 3 lakh units which it sells in the market. So your total contribution is 48 lakhs. Division X makes a contribution of 48 lakhs by selling to the internal customer. Figure directly भी workout कर सकते हो 16 multiplied by 3 lakh. But I will not recommend. I will always advise the students to prepare this out. You must ensure that every element of cost you have captured in the calculation. So 16 rupees is the contribution multiplied by 3 lakh gives you contribution of 48 lakh. This is for division X. And division Y का तो देखो, division Y I told you this figure you should note it has to be made 94. 47 multiplied by 2. Division Y is procuring this component from the external supplier now at 47 rupees per unit. और 2 unit लगते हैं for manufacturing 1 unit of finished product. So 47 multiplied by 2 is 94. Don't forget. In the earlier scenario, it was 50 multiplied by 2. We had taken 100 rupees. आलं ना give it 2 minutes आलं बोलायला लाग आज एक अपॉलॉजी बोलून टाकणारच बोलता रेन्स आणि विंड ओके so if you look at this 47 multiplied by 2 94 rupees is the special price which division Y gets from the external customer and therefore the contribution comes to 44 rupees. Directly also I was telling you can multiply 44 rupees contribution by 1,20,000 units and 44 multiplied by 1,20,000 you get total contribution of 52,80,000 and when you minus the fixed cost from 50 to 80, 20 lakh fixed cost you get total profit of 32,80,000. And if you add profit of 30 to 80 to 8 lakhs, your total profit for the company as a whole is 40 lakhs. Yeah, and I have highlighted this figure because profitability of the company as a whole has come down drastically from around 75 lakhs to 40 lakh 80,000. If you have any questions in understanding any of these figures, you can please ask. But as I told you, you are not expected to do these calculations so much in detail. If you wish, you can also do a direct calculation where contribution per unit you can multiply by number of units. Right, and get the total profit. That is also possible. But to be on a safer side, better to prepare a chart. Now let us look at the analysis. So all of you have understood in the first scenario, we said in the current scenario, 2,60,000 units you are supplying. This case study should linger in your mind and it should be focused with all the numbers in mind so that analysis will be easy. In the first scenario, we said internal customer, you are supplying 2,40,000 units. X division is supplying 2,40,000 to internal and 2,60,000 to external. That's it. But now in the new scenario, it is supplying 3 lakh units to external and nothing to internal because internal customer is procuring from the outside market at 47 rupees. Now you can see overall profitability has reduced from 75 lakh 20,000 to 40 lakh 80,000. Both these figures are visible in respective tables. Our original profitability was 75 lakh 20 I had highlighted and the new profitability is 40 lakh 80,000. So reduction in profit is 34 lakh 40,000 per annum. We are analyzing why there is a drastic reduction in profit. And we are analyzing the reasons, the factors which have contributed to drastic decline in the profitability. Now there are two factors. One factor is, of course, I was telling you, cost of manufacturing in-house is only 30 rupees per unit. You are manufacturing JEX, that is component division X is manufacturing this component at 30 rupees only. Material cost, labor cost and variable overhead only 30 rupees. Whereas division Y is procuring from the market as 47. In marginal costing, I told you, you always do cost benefit analysis, make versus buy. If the relevant cost of making the component is 30 rupees, and if cost of buying is 47 rupees, obviously nobody would like to buy from the market. Everyone would like to make internally. So internal cost of manufacturing, relevant cost is just 30 rupees and Y is procuring at 47 rupees. So it is spending an extra 17 rupees for purchase from the supplier, external supplier. And how many units it is purchasing? 2,40,000. 1,20,000 units of finished product manufacture करने के लिए 2,40,000 units of component required. So 2,40,000 units of component multiplied by 17 rupees. So total loss made is 40,80,000. I have highlighted this. ये 40,80,000 लॉस इसके लिए आया because probably that cost benefit analysis has not been done by division Y manager when division X is producing internally at such a low price, 30 rupees relevant cost. 30 rupees relevant cost obviously because we are not calculating or taking into account selling and distribution cost. So this is the main loss, but still the loss is reduced to 34,40,000. You can see this. 40,80,000 का loss actually हुआ है, but वो loss थोड़ा reduce हो गया. Because now to that extent there is a profit also from sale to the external customer. Division X no longer makes checks for internal sales, so it can ramp up. Ramp up means increase its external sales to meet the full annual demand of 3 lakh units. This is the point I am highlighting. Now you can cater to the external market at full annual demand of 3 lakh units. This is the point. Now if you cater to the external market 3 lakh units, obviously you are making an additional contribution from 40,000 units. Earlier model was division X was supplying only 2,60,000 units to the external market, but now it is supplying 3 lakh units. So 40,000 units extra supply कर रही है, and 40,000 units supply करने से 16 rupees per unit का contribution extra मिल रहा है. So it is earning an extra contribution of 16 rupees per unit. 40,000 units it is supplying extra to the external customer. That is why I have given this elaborate in the narrative form in the Word document for the only reason that you have to understand the logic, the rationale, the reasoning, logic, rationale, reasoning, why we have done like this. That is why I have given in the Word document, and that too in the form of narrative comments. Now these narrative comments you can write in the exam the way it strikes you. You are not supposed to, write in the same manner. You can write in your own language also, so long as you understand. And of course, the other person who is reading your answer should understand what have you written. So 40,000 units extra you are selling to the external customer against 2,60,000, 3 lakh units now you are selling. So 40,000 units से 16 रुपया per unit contribution, आपको 6,40,000 का extra contribution आ गया. So that means the extra contribution of 6,40,000 rupees is offsetting your loss of 40,80,000. Loss is 40,80,000. That is loss from buying from external supplier at 17 rupees extra cost. उसका लॉस आया 40,80. We are talking from company's point of view. And 6,40,000 का प्रॉफिट हुआ डिवीजन X को by selling it to the extra profit by selling it to the external customer. So 40,80,000 minus 6,40,000 gives you net loss of 34,40,000. So I'll show this working over here. Netting is given, but still I will write 40.80 lakhs minus 6.40 lakhs. 40.80 minus 6.40 gives you net loss of 34,40,000. This is the figure which we have reconciled, and that brings us to the analysis of profitability for the company from company's point of view. 34,40,000 was the reduction in profit. See, 75,20,000 was the original profit in scenario 1, current scenario. Scenario 2, the profit for the company reduced to 40,80,000. So reduction in profit by 34,40,000. उसके दो reasons है, दो factors है. So इसके लिए we are preparing a reconciliation for 34,40,000. Just as in standard costing we arrive at the variance and we say variance on account of price change and variance on account of volume. That means price effect and volume effect. For any cost effect, we say price effect and volume effect. और सेल्स वैल्यू, प्राइस इफेक्ट, वॉल्यूम इफेक्ट. सिमिलरली 34,40,000 जो लॉस हुआ, रिडक्शन इन प्रॉफिट हुआ कंपनी के लिए, व्हाट आर द फैक्टर्स रिस्पॉन्सिबल? फर्स्ट फैक्टर रिस्पॉन्सिबल इज यू आर प्रोक्योरिंग फ्रॉम द एक्सटर्नल सप्लायर एट अ हायर प्राइस व्हेन कॉस्ट ऑफ मैन्युफैक्चरिंग इज सो लो. And second is, against that, also made some extra profit by Division X made an extra profit by catering to the full demand of external customer, that is 3 lakh units as against 2 lakh 60,000 units in the first scenario. So 40,000 आपने extra supply किया, तो 16 rupees per unit से 6,40,000 का extra profit हो गया. That 6,40,000 is adjusted against 40,80,000 and you get net loss, netting both A and B above, net loss to the company is 34,40,000. Now friends, you understand what a challenge in the exam to keep tab, TAB tab, to keep tab on each and every number, to keep track of all the data what is given and to keep in mind all the scenarios. That is a great challenge in the exam, and at any single moment of a second also, you cannot afford to lose your focus. So in this chapter on transfer pricing, always maintain the focus, and peculiarly in strategic cost management, when you are solving such lengthy questions in costing, you have to have focused attention and control. I always do like this, control over each and every figure. Each and every figure you must have control. So this is 34,40,000 analysis of profitability from company's point of view. Now look at from division Y and division X point of view, because that is also the question. Question asked is, how has each division impacted or affected because of this procurement decision of division Y to procure it from the market at a concessional price of 47. ये decision का असर division Y पर क्या गिरा, division X पर क्या गिरा. Yeah, so we are analyzing now the profitability of each division. So look at division Y, impact on profit of division Y. It increases from 25,60,000 per annum to 32,80,000 per annum. You can go up and you can see this 25 say 32,80,000 is the profit of division Y. I'll take you to the table again. See here 32,80,000. I'm highlighting the second figure now of division Y profit, overall profit 32,80,000. See this table now you understand is required for at least division wise breakup of profitability is required to enable you to give your comments. I repeat, division wise analysis of profit is required. Division wise analysis of profit is required to enable you to give your comments. So for giving comments, at least these figures are required to be worked out. Now I can quickly pick up the figures and put it in my comments. In the current scenario, the profitability of division Y was 25,60,000. Now this is the profitability of division Y in the current scenario, which has gone up to, from 25,60,000 it has gone up to 32,80,000 in the proposed scenario. So profitability of division Y has improved. So remember these figures from 25 to 32 to 80. Now this is what is expressed over here. The impact of profit on division Y increases from 25,60,000 per annum to 32,80,000 per annum. That means increase in profit is by 7,20,000 rupees per annum. Now this is again, you have to give the breakup why there is an increase in profit of 7,20,000. So you will have to 7,20,000 you are giving an account of 7,20,000. You will have to give reconciliation. That's what I say. This is due to saving in procurement cost of component for division Y. Instead of procuring jacks at rupees 50 per unit, division Y proposes to buy from external supplier at 47. So now think, see, when you are looking at division Y, think only from the point of division Y. That time don't look at from the company's angle. You are discussing the impact of on profitability of division Y. So don't discuss from company's angle. Think only from the perspective of division Y. अब तक division Y कितने में purchase कर रहा था? Division X से 50 रुपए में procure कर रहा था. अभी 47 rupees में procure कर रहा है. from the external supplier. So 3 रुपए का saving हो गया, 3 rupees saving, 50 minus 47, 3 rupees saving. On how many units? 2,40,000 units. Why 2,40? 1,20,000 multiplied by 2. So 2,40,000 unit पर 3 रुपए बच गया. So 24 into 3, 72. So straight away the saving of 7,20,000 for division Y. Straight away in one line also you can conclude, you can just focus and say there is a saving of rupees 7,20,000 for division Y, and saving has resulted in extra profit. Profit has gone up for division Y because of cost saving. 50 रुपए की जगह 47 rupees में you are procuring from external supplier. I hope this is simple and clear to you. Now look at from division X point of view. Division X profitability has reduced drastically from 49,60,000 in the current scenario to 8 lakh in the proposed scenario. Now there is a drastic reduction in profitability of division X, and probably that is why company's profitability also has reduced. We have seen 49,60,000 was the current scenario, existing scenario, profit of division X. And now the proposed scenario, profit of division X is 8 lakh. Substantial reduction, I must say, of 41,60,000. Substantial reduction in the divisional profit of X. Right? This again I am highlighting, and as final CA students you have to give reconciliation of this 4160. Now what is this breakup of 41,60,000? Division X earns a contribution of rupees 20 per unit objects from its internal transfer to division Y. ये 20 rupees contribution कैसे आया? 50 रुपए selling price less variable cost of manufacturing only 30 rupees. 4 rupees selling and distribution we have not taken into account. So बाहर के कस्टमर के लिए when sell करते हैं तो 16 रुपए contribution था. But now when you sell internally to your internal customer, contribution is 20 rupees, higher contribution. Obviously because you are not charging 4 rupees selling and distribution overhead to your internal customer. So your contribution is 20 rupees. Now if per unit, remember this, if division Y procures this externally, it would result in annual loss of 48 lakhs in contribution for division X. कैसे लॉस होगा? 2,40,000 units. Now it will not have any market demand, right? It will not have demand of the internal customer. 20 rupees per unit is the contribution that otherwise would have been earned had it sold, had division X sold it to your internal customer. Abhi your division Y is procuring from the market, so division X will not be in a position to sell it to the internal customer. So 48 lakhs का straight away annual loss हो गया division X को. We are reconciling this loss of division X. ये फिगर कैसे आ रहा है उसका ब्रेकअप दे रहे हैं. 41,60,000 ये जो लॉस आ रहा है डिवीजन X को, रिडक्शन इन प्रॉफिट मींस लॉस. Reduction in profit means loss. We are giving the breakup of 4160. So first reason is annual loss of rupees 48 lakhs because now division X is not supplying to the external, is not supplying to the internal customer. So there is a loss of revenue, loss of contribution, and loss of contribution at rupees 20 per unit for 2,40,000 units. So 48 lakhs ka annual loss hai. However, due to additional external sales of 40,000 units of JEX, division X has earned additional contribution of 16 into 40,000, that is 6,40,000 per annum. This I have given, I told you, purposely in narrative form so that I could express the logical reasoning for this. So there is an annual loss of 48 lakhs, right, by not catering to division Y. Division X, now when you are discussing from division X point of view, don't confuse, don't discuss from company's point of view, don't think from companies, one at a time. आप company's point of view discuss करते हो तो holistic approach, overall view. When you discuss only from one division's point of view, don't think from the company's point of view. What will happen is otherwise there will be an overlap. This kind of discipline you will have to maintain. In your analysis, logical analysis, you will have to maintain this kind of discipline. That whenever you are a manager of a particular division and thinking from one division's point of view, for the purpose of analysis or comments, you will discuss only or think only from the point of view of that division and not from the point of view of company as a whole. Remember this. And therefore, division X is, you have seen, incurring a loss of 48 lakhs, right, by not catering to the internal customer. But on the other hand, it is now supplying additional 40,000 units to external customer and therefore making a contribution of 16 rupees per unit into 40,000. So 16 into 4 is 6,40,000 rupees. So additional contribution made from external sales 6,40,000 offsetting the loss to some extent of 48 lakhs. So 48 minus 6 lakh 40 gives you the lower contribution of 41 lakh 60,000. So this is what is breakup of 41 lakh 60,000 lower contribution. I am writing into bracket. Those who are taking down the numbers also can write the working. 41 lakh 60,000 is nothing but 48 lakhs minus 6.40 lakhs. 48 minus 6.40 lakhs. This is the breakup of 41 lakh 60,000. So division X is making an annual loss of 48 क्योंकि division Y उनसे purchase ही नहीं करती. So 20 rupees contribution per unit lost from 2,40,000 units, 48 lakh rupees lost, and vis-a-vis that earned only hardly 6,40,000 from sale to the external customer. So there is a net loss of 41 lakh 60,000. That is reduction in profit. Now this also results in excess capacity of 2 lakh units per annum in division X. Now this aspect I cannot forget. That is a qualitative aspect, and qualitative factors also will have to be quantified as much as possible. If not quantification, at least they will have to be cited. You remember in business decision making, always we have combination of quantitative factors coupled with or in conjunction with qualitative factors. We always have combination of quantitative factors coupled with in conjunction with qualitative factors. So excess capacity of 2 lakh unit. देखो capacity कितनी है total? 5 लाख की capacity है division X की. Is it manufacturing 5 lakh? Certainly not. It is manufacturing only 3 lakh for external customer. So 2 lakh की surplus capacity बच गई. Now that surplus capacity or idle capacity, who is going to purchase this? Nobody. Market demand is fully catered. External market demand is fully catered. So who is going to buy this 2 lakh? Nobody. So obviously morale and motivation of employees who are working in division X will get reduced. It will be adversely affected. Some of the contract employees who are working in division X so far all these years, last 3 साल से purchase कर रहा है. Somewhere in our case study it has been mentioned that division Y has been procuring this component from division X for last 3 years. 3 साल से आपने contract employees रखे हैं, on a regular basis. Now these contract employees will have to be terminated. They will have to be given a layoff. And because of which there will be again morale and motivation that will be adversely affected of employees. And these are qualitative factors, of course. The brand image, what goes in the market, that there is a conflict between the two divisions. कुछ तो गड़बड़ है. Two divisions में कुछ तो गड़बड़ है. There is some conflict going on. So it spreads a wrong reputation in the market. The brand image of the company is at stake, and therefore it is always better to resolve our internal conflicts. We always say घर की जो बातें हैं घर में ही रखो. Why to spread in the market? घर में कुछ झगड़ा है, घर में कुछ internal conflict है, then let us resolve the conflict internally and let's not spread it out in the market, because it will have bad reputation from the point of view of the image, brand image of the company. Now these are qualitative aspects which are not highlighted here, but obviously have to be taken into account. So एक line में लिखा है, this also results in excess capacity of 2 lakh units per annum in division X. Because now division X is no longer catering to division Y, it is left with excess capacity. I hope all of you have understood both the scenarios, scenario 1 and scenario 2. Right? Slightly there was, yes, a disturbance in between, right, because of the net issue. But all of you by this time, because of my repeated commentary, repeated summing up of the numbers, figures and the comments, you all would have understood this properly. So situation 1 is the current situation, status quo, as is varies, status quo. जो present चल रहा है चलने दो. Present क्या चल रहा है? 2,60,000 यूनिट एक्सटर्नल कस्टमर को मार्केट में सेल करो and 2,40,000 यूनिट इंटरनल कस्टमर को बेचो. That means division X is supplying 2,60,000 units to external market and 2,40,000 units to internal customer. That is current. Proposed scenario, you sell, division X will sell only 3 lakh to external customer and nothing, 0 to internal customer. Because internal customer is now buying from external vendor. Look at this situation. See, nobody can be dependent on others. right? You can always say that everyone is self-dependent and independent rather, right? And therefore, they will look at in a selfish manner from the point of view of their division. This is the general tendency in any organization. Two managers in charge of two divisions will look at from the point of view of their profitability, because their performance bonus is at stake. They will not look at from the organization's point of view. And all the more, therefore, that leads us to the third part of the question. Should top management intervene in this case? If yes, why? And how should it convince both the divisional managers and set up the transfer price? That is the question that is asked. So let us look at subpart number 3. The last part of the question, that should management intervene, top management intervene to achieve the concept of goal congruence, right? Now you have seen here, company has suffered a loss of rupees 34,40,000 per annum, right? Overall loss is there. We have seen that, yeah. The overall profitability of the company has reduced by 34,40,000. If division Y decides to procure this from the external supplier, it costs rupees 30 per unit to manufacture checks internally as compared to 47 rupees per unit that division Y is willing to pay to the external supplier. So we are aware that cost of manufacturing is much lower than cost of procuring from the market, and that is the basic reason why so much of huge loss of 34,40,000 suffered by the company. So it is a cause of concern. It is a cause of concern. Now 34,40,000 loss is a cause of concern. I am highlighting this. Cause of concern. This word you must mention, because top management is worried. Cause of concern. Inverted comma. This word is very important. Cause of concern. I am highlighting this. Company's profitability on a per annum basis reduces by 34,40,000 is a cause of concern, and therefore all the more intervention by top management is required. But division X is unwilling to reduce the price from rupees 50 per unit, since divisional performance is done based on the profit margin ratio of the division. Since divisional performance is done based on the profit margin ratio of the division. Therefore, management of the company has to step in to promote the goal congruence. Now, this is the key line. Management has to intervene. Management has to rope in, has to pitch in to promote goal congruence. If division Y buys checks from external supplier, not only it is costly for the company, but it also results in lot of unused capacity lying idle in division X. So this is also a summing sentence that why top management has to intervene, because if division Y continues to buy from the external market, external supplier at 47 rupees, not only division X makes a loss, that's 100% true, but also it will result in, company will make a loss, division X will make a loss, but it will also result in unutilized capacity lying idle in division X. And in the current scenario, one possible way of arriving at, that is the alternative acceptable transfer price range could be, now price you have to discuss in the current scenario, the acceptable price range of transfer price could be, division X is currently working at its full capacity of 5 lakh units. Currently, division X is working at full capacity. We all have understood the minimum transfer price to be charged by a selling division when its hands are full, when it is operating at full capacity, is equal to its marginal cost plus opportunity cost. You remember the formula? Marginal cost of making plus opportunity cost. Right? That will have to be recovered because hands are full. So in the current scenario, 5 lakh units are being produced. In fact, of this production, 2,40,000 units is supplied internally to division Y, while balance is supplied to the market. So marginal cost of production of checks is rupees 30 per unit. If this were to be sold externally, it would earn a contribution of rupees 16 per unit. See, you discuss in the negative way, in the other way, that if this, whatever you are catering to the internal customer, had you catered to the market, you would have earned a contribution of 16 rupees per unit. Now you are deprived of, because you are giving first priority to your internal customer, and therefore you are deprived of market contribution of rupees 16. Market is yielding a contribution of rupees 16 per unit for division X. अभी वो 16 रुपए मार्केट से नहीं मिलेगा, because you are catering to your internal customer. So your own cost of relevant cost of manufacturing is 30. Relevant cost is marginal cost always. We know the formula. Formula is minimum price transfer price that could be charged is equal to marginal cost of production per unit plus opportunity cost. So 30 rupees per unit is the marginal cost plus 16 rupees per unit is the opportunity cost. So 46 rupees will be the transfer price per unit that can be charged by division X to division Y in the current scenario. The other way of looking at this could also be division X does not incur any selling and distribution cost. See, that is how it is able to save that 4 rupees. 50 रुपए अभी का प्राइस है which is being sold to internal customer at 50 rupees. 50 rupees में 4 रुपए और कम करो which is selling and distribution cost. Right? Frankly speaking, 4 rupees should be deducted from 50 rupees because 4 rupees cost you are not incurring for division Y. Division Y तो अपना sister concern है, brother concern है. That means we are not going to recover any selling and distribution cost from division Y. So if you reduce from 50 rupees that 4 rupees, automatically your answer comes to 46. So that way also it tallies. That 30 plus 16 is also 46 and 50 minus 4 is also 46. So to outside clients, it needs to spend rupees 4 per unit towards the same, and therefore to make its price more competitive with the external market, division X can reduce the price by rupees 4 per unit. Very simple. This I have given in the bracket, so because you can argue in both ways. आप ऐसे भी आर्ग्यू कर सकते हो 30 plus 16 is equal to 46 और you can argue 50 minus 4 is also equal to 46. 50 रुपए नॉर्मल चार्ज कर रहे हैं बट अभी 4 रुपए चार्ज करने की जरूरत नहीं है. सेलिंग एंड डिस्ट्रीब्यूशन कॉस्ट. सो 46 रुपीज यू कैन चार्ज, यू कैन अफोर्ड टू चार्ज. डिवीजन X कैन अफोर्ड टू चार्ज 46 rupees per unit to division Y. That is the point I am driving. So based on its cost structure and competitive profit margin it earns from external sales, it can price its internal transfer at 46 rupees. That is also there. So this 46 can also be worked out as I am writing 50 minus 4. This is another way of putting it. That is why I have kept it in bracket. 50 minus 4. That is also 46. I have highlighted 50 minus 4 is also 46. So the course of action probably now top management has intervened in this conflict and they realize whenever top management intervenes in the conflict, they will go by the price range, which I told you in the last class, that whenever there is a conflict between the two divisional managers, top management will intervene. And once top management intervenes, there will be price range or price band. Price range will be minimum transfer price and maximum transfer price. Minimum transfer price from selling division's point of view, maximum transfer price from buying division's point of view. And selling division will recover variable cost plus opportunity cost if hands are full. So in that sense, it is 30 plus 16, that is 46 rupees that will be recovered. And that is what we have seen. 30 plus 16 is 46 rupees. 30 plus 16 is 46. Or 50 minus 4 is 46. So division Y will be willing to pay lower of net marginal revenue or the external buying price. So you know the formula. Net marginal revenue per unit of Jextin for finished product is selling price minus marginal cost for division Y other than cost of Jex. All of you know the formula we had seen. From the buying division's point of view, maximum transfer price could be. From the buying division's point of view, maximum transfer price could be lower of net marginal revenue or external buying price. That is lower of. This also I am highlighting in the formula. We have seen that from the buying division's point of view, lower of net marginal revenue or external buying price. The external buying price कितना है? 47 rupees. Division Y can procure from the market at 47. And let us calculate net marginal revenue. Net marginal revenue is selling price minus marginal cost of division Y other than cost of Jex. So we have 180 rupees is the selling price of Jextin minus marginal cost of division Y other than the cost of Jex is 42. So rupees 138 per unit of Jextin is the cost, and per 138 को divide by 2 करो because this is the cost of 2 units, all of you understand. So divided by 2 you get the figure of 69 per unit. So this translates that division Y will be willing to pay up to rupees 69 per unit of Jex that it can incur without incurring a divisional loss. If division Y does not want to incur a loss, it can afford to pay. It can afford to pay up to rupees 69. You must understand this figure of 69 very clearly. 69 is 138 divided by 2. I am writing over here into bracket 138 divided by 2. Why 2? Because 2 units of component required for manufacturing 1 unit of finished product. So when you say 138 rupees is the net marginal revenue, you can't compare 138 with 47. It is not a like-to-like comparison. So you have to compare net marginal revenue with external buying price. External buying price is 47 rupees. You can't compare 47 with 138 because 138 is the cost of 2 units. So usko divide by 2 karo and you get 69 rupees. Now it is like-to-like comparison. So 69 and 47, which is lower, 47 is lower, and therefore external buying price of 47. Yeah, that is what, meanwhile external buying price is 47 and therefore maximum price division Y will be willing to pay is the lower of net marginal revenue, that is 69 rupees or 47 rupees, whichever is lower, obviously maximum of 47. So this I am highlighting. See, each figure is a derived figure, each figure is a calculated figure based on our analysis, based on our logical understanding of the case. So it is extremely important. You have seen the calculations were not very tedious. Calculations were not very difficult. But keeping track of each and every number and particularly the scenario is very essential. In case studies on transfer pricing, generally that is the challenge students face. Calculation per se doesn't require much of laborious task. It's not a laborious task. Calculation doesn't require much of hassles. But putting the thoughts in the right direction, that is a challenge. So Y is willing to pay 47 rupees. Between 47 and 69, 47 is lower of the two. So Y is willing to pay maximum 47, whereas X is willing to sell at 46. So the transfer price will range between 46 and 47. So we have seen the tutu meme here. The negotiation now will revolve around 46 and 47. So this is the price range I am highlighting from this discussion. Price range is 46 to 47. 46 rupees from the point of view of selling division, minimum selling price, and 47 rupees is the maximum buying price from the point of view of buying division. So buying division is ready to pay 47, selling division is ready to sell at minimum 46. Anything above 46 is welcome. So now division X would have to compete with external supplier to retain its internal sales. This is the very key line or punch line in this entire analysis. Now, when division X has reduced its internal transfer price from 50 rupees to 46 rupees, and by the way, it can afford also, because 4 रुपया recover करने की जरूरत नहीं है selling distribution cost. So, when division X is reducing its transfer price from 50 rupees to 46 rupees, it will now start competing with external market. Right? And external market, obviously, because it has to retain its internal sales. If it doesn't cater at 46 to 47 range, then your division Y will procure it from the market at 47. Look at the catch-22 situation. This is called in, management games catch-22. You are really into catch, This would promote more efficient working between division X and Y. दोनों को अपना limitation पता चला है. Both the divisions are aware of their own limitation. Division Y का limitation है. Yes, it procures from the market, but then it acts detrimental to the profitability of the company. Division X, if it tries to supply to division Y at 46, then it has a challenge of maintaining the quality as well as the cost vis-a-vis the competitor. So by selling it at rupees 46 per unit, contribution of division X would be maintained at 16 rupees per unit. For division Y, procurement of checks at 46 would be beneficial. The maximum 47 देने के लिए तैयार है. So 46 rupees definitely they will be ready because it is lower than the external market price. If they procure from market, it is 47. Internal supplier is charging at 46. So by charging at 46, division X makes a profit of 16 rupees, contribution of 16 rupees per unit, and division Y also saves rupee 1 as compared to the market price. So if transfer price is set at external market rate of 47, division Y still would be able to improve its profit margin as compared to original transfer price of 50. Correct? So any price between 46 and 47 is alright. 46 है तो भी division Y is happy because it is willing to pay 47. 47 है तो division Y of course is happy because that is the upper limit. Beyond that, it is not going to get ready for payment of any extra fee. But 47 or 46 doesn't make difference for Y Limited. Y Limited के लिए still the profit margin will improve because the original transfer price is 50 rupees. तो 50 से तो कम कर रही है Division X, and Division X at 46 will still make a contribution of 46 vis-a-vis it is supplying at 46, so we'll maintain a contribution of 16 rupees. Yeah, 46 minus 30. Now marginal cost of manufacturing checks is only rupees 30 per unit. Management has to ensure that production of checks is made in-house. So one thing is very clear from this entire analysis and discussion, that better to manufacture the product in-house when it is when the cost of manufacturing is just 30 rupees rather than procuring it from the market at 47 rupees. And one can always supply it to our internal customer at 46. Performance measure at a divisional level should then be restricted to financial performance alone. Full profit responsibility. Actually, when division X is supplying to division Y at 46, it is not getting full profit. 50 रुपए में शायद full profit मिलेगा, but 46 में full profit नहीं मिलेगा. But accordingly, the performance measures should be modified. What we call include non-financial or operational measures as well. ये बहुत मतलब की बात की है, and this is a very important point. That in the process what has happened is, what is the conclusion or moral of this case study? Finally, when the top management intervenes in this conflict, it will ensure that division X supplies to division Y at 46 rupees only. 46, 47, 46, 47 कुछ भी चलेगा, but 46 rupees only it will transfer for the only reason that it makes a division X makes a contribution of 16 rupees. Yeah, and division Y के लिए it is still 1 rupees cost reduction. Because market में 47 में है, तो 46 में it will procure from internal supplier. Right? So it is a win-win situation. But in the process, who is affected is division X manager, because division X manager अब तक supply करता था last 3 साल 50 रुपए में. अभी suddenly उसको 46 rupees में supply करना पड़ेगा. So obviously he has to take a cut, CUT cut. He has to take a cut in terms of his profitability of his division. But top management should be considerate enough. Top management should consider all these points and should incorporate or rope in some non-financial performance measures or some other factors, operational measures, or should take into account the kindness on the part of division X manager. How kind is division X manager that it is supplying to division Y at 46 rupees? Right, by taking a cut in its profitability. So ideally speaking, top management should not allow division X manager's performance bonus or performance incentive to be affected drastically. Yeah, his performance should always be maintained at a higher level and should be evaluated also at a higher level so as to enable him to get the incentive by incorporating non-financial and operational measures. आपको पूरी केस स्टडी समझ में आई? उल्टा डिवीजन एक्स मैनेजर ने मदद ही किया डिवीजन वाई मैनेजर का बाय सप्लाइंग एट 46 एंड दैट टू इन द इंटरेस्ट ऑफ द कंपनी एज अ होल. रिमेंबर दिस इन्वर्टेड कॉमा, इन द इंटरेस्ट ऑफ द कंपनी एज अ होल. Division X manager has taken a cut. So somewhere he should get credit. His efforts or his kindness should be acknowledged by the top management by incorporating non-financial factors or operational measures at the time of performance evaluation. Now look at a very rich content of this case study. This case study is very, very rich in its contents because it has got all flavors. Status quo flavor, that is as is where is basis. Second one is change scenario, that is market dynamics keeps on changing. Suddenly now there is a supplier in the market. This happens in real life, that suddenly all these years I have been procuring from my internal supplier, but now suddenly there is a supplier in the market who has brought out maybe competitive measures, cost reduction, competitive strategies, cost reduction or competitive strategies. And he has been able to reduce the cost and he's offering the product at 47. Right? Now here comes the benchmarking. Here comes what exactly can be done to reduce our cost also. So supplier 47 में supply कर रहा है and that is why the whole turbulence is created. ये turbulence होता ही नहीं था. ये सब case study emerge ही नहीं होता था if supplier had not supplied at 47, because 3 years से 50 रुपए में raw material or component ले रहे हैं. Division Y is procuring this component for last 3 years and this supplier is now assuring at 47 for next 4 years. So obviously long term benefit point of view division Y manager will take. So turbulence is created and we are compulsorily made to discuss this case study. By the way, students, this is a real life scenario which happens in practical life also. So it is not just a bookish case study, but as management consultants, management accountants or chartered accountants, we should be in a position to do analysis of the situation based on the cause data. Analysis of the given situation based on cause data. So this cost you have analyzed, to the fullest extent, and you have looked at the situation, adapted yourself according to the situation. That's a must in every case study. I have finished discussion of this case study. We will take a short break of 10 minutes and then we'll resume with the next case study on transfer pricing, which is equally elaborate and equally comprehensive. But at least now the thought process is on. You have set the ball rolling. You have set the thought process in place. And based on this, now you'll be able to grasp the third case study on transfer pricing very fast. Meanwhile, I will look at the questions. If you have any on this case, please ask in the link that is provided to you. We will take a short break of 10 minutes. Thank you. Now we look at another case study on transfer pricing. Meanwhile, I have gone through your questions during the break, and yes, most of the students are asking for sharing of this Word document. This Word document, as I told you, contains all case studies. I taught you two topics, one performance measurement and evaluation, wherein we had discussed 7 case studies in the class. And in this transfer pricing, again, we are discussing the case studies. All these case studies are compiled in one Word document file. So once both these topics are over, as a consolidated file for both the topics, you will get this Word document that will be shared with all of you through a technical team. So friends, don't worry about the contents of these cases, because once you get the soft copy of the case study file, obviously you will be in a position to read the case along with the solution, along with the approach in detail. And based on the self-study plus based on the recorded voice is already recorded, and therefore you can listen to the recorded voice sessions from the YouTube, and you can always catch up with whatever you had missed out in between due to lack of clarity or anything. But these Word document files will definitely be shared with you once the complete topic is over. That means once transfer pricing we are through with, then as a consolidated note, both these topics will be covered in one Word document, and that will be circulated. I think now the communication is clear to all of you. One of the students has asked query about GMCS or the advanced ITT, etc. We don't, entertain these questions here on this platform. Separately you take up these questions with BOS. Also, one of the students has asked for, one clarification. The case study which we covered just now, case study number 3, which we covered first, that was division X and division Y. That case study, very interesting case study, it is not given in your module. This case study was asked in November 19 exam for 10 marks. So if you refer to the November 19 question paper, you will find this November 19 is the latest question paper on strategic cost management. You will find this case study in November 19 question paper. And therefore, still you have not missed. So those of you who would like to refer to the question paper and a suggested answer can always get understanding of this case and the approach. And of course, coupled with that, my recorded voice based on the downloaded sessions from YouTube. So that is how you will be able to make sense in what I was talking. So now we have case study which is from the module. Every case study may not be from the module. So the student who has asked this question, please bear this in mind. Every case study we need not take from the module. In fact, case studies which are asked in the exam in this paper most of the time are altogether new. They are combination of 2 or 3 scenarios which are given in your module. And that's why we have to be prepared for all types of uncertainty. At CA final level, we have to be prepared for all types of uncertainty. Don't be under impression that same to same case study which is given in the module will be reflected in the exam. Yeah, that would be everyone's wish, but that will not and may not come true. So there is always a combination of 2-3 case scenarios, 2-3 case situations, and one new case study is compiled. It is prepared, drafted, altogether new case study, a fresh case study, which probably as it is you have not looked at in the module, but somewhere or the other the glimpses, somewhere or the other the references are there in the module. So the earlier case study which we discussed was exclusively from November 19 question paper. I hope that answers the question of one of the student. You are right, this case study was not in the module. However, the case study which we are going to now understand, case study number 2, this is very much from the module. It is given in the form of illustration, solved illustration in the module. In the module, there are 2 types of questions. One is test your knowledge, which is at the end of the discussion of the topic. And second type is in between the discussion. You have illustrative cases. So this is a sort of an illustrative case which is there in the module itself. So still you can open the relevant page from the module. If I am not mistaken, this is contained on page number 9.22 to 9.26. Somewhere plus minus 1 here and there, but it is from 9.22 to 9.26. That is the reference of the study material or the module. of this case. I have highlighted some of the points. I have also increased the font size, so visibility is also good. But I have always been telling you from time to time that whenever there is a data, see, this paper involves a lot of data, cost data. So whenever there are numbers, figures or cost data, you can always take a quick pick from here and keep it as a backup, so that when other things are being discussed, when analysis is being discussed, narrative commentary is being discussed, you can correlate, you can do the mapping of this analysis with the original data. I hope you are getting what I'm saying, that you can do the mapping of the approach, what I discuss in the class, the analytical comments, what I discuss in the class. You can do the mapping of that approach or analytical comments with the original data given in the case study. So you can always take a pick, or you can jot down the key numbers. I go very slow so that you can understand this step by step. A company has two divisions, A and B, making products A and B respectively. One unit of A is an input for each unit of B. Such a great relief. In the earlier case study, all of you remember, 1 unit of finished product required 2 units of component, raw material. So ratio was 2 units of component for 1 unit of finished product. In this case, it is 1 for 1. So that is straightforward. When you have 2 units for 1, etc., then you have to keep or bear in mind that every time the cost which is given to you, you have to convert by either doubling or by dividing by 2. And we have done that from time to time. You have seen that in the earlier case study. So be careful. B has production capacity of 45,000 units and a ready market. Other information available regarding division A is as under. Capacity in production unit is 50,000. So A's capacity is to manufacture 50,000 units. B has a production capacity of 45,000 units and ready market. So obviously B will require 45,000 components from division A. Now maximum external sales which A can make is 30,000. So that means 30,000 is the external demand, then it can cater to the internal customer only to the extent of 20,000. But that will not happen because first priority is always to internal customer. Fixed cost up to 30,000 units. Beyond 30, this is given as 4,30,000. It is given, it is pushed down. So it's in order now, aligned. Fixed cost up to 30,000 units is 4,30,000, and beyond 30,000 units, it increases by rupees 50,000 for every additional 10,000 units. So fixed cost remains fixed up to a certain level. All of you know the basic fundamental of costing, and it increases thereafter beyond certain additional units. Variable manufacturing cost per unit is 55. Variable selling cost per unit for external sales is 10. Variable selling cost per unit for special order transfer to B is 5 rupees. That means we had seen in the earlier question also, selling and distribution overheads we do not recover from our internal customer. So variable selling cost to external customer is 10 rupees, but variable selling cost for this transfer to B or special order is just 5. So this demarcation, this bifurcation, you'll have to keep in mind. And that discrimination will always continue between external sell and internal transfer. Selling price per unit for external market is 80, whereas selling price for special sales is 70. Obviously, because we are in a position to pass on that benefit to the internal customer, because we don't recover from the internal customer our selling and distribution costs. Selling and distribution costs we don't charge to the internal customer. So I think this data is clear to all of you. The interpretation of the data, please take a peek of this data. What I request all of you, those who don't have the handy module right now, can take a peek of this data and keep it, or keep these figures as handy reference somewhere you jot down in your notebook or in the writing pad, so that it will serve as a backup or a reference material when we are solving the question or when we are discussing the analytical comments on the question. So capacity is to produce, this is data for division A. Data for division A. It is given very category. Capacity is to produce 50,000 units. External sales 30,000. Fixed cost up to 30,000 is 4,30,000. Beyond 30,000, fixed cost increases by rupees 50,000 for every additional 10,000 units. Variable manufacturing cost 55. Variable selling cost for external sales 10. For special customer or transfer to be internal transfer 5. selling price to external market 80, and selling price for special sales is 70. This is the data, and division A is transferring to division B. Division B has a capacity of 45,000 units and ready market. That means it can manufacture 45,000 units provided it gets 45,000 units of raw material from division A. So this is the complete understanding now. We read the narrative data. B can buy the input A from outside at a slightly incomplete stage, at rupees 45 per unit. So B can buy this input A from outside at a slightly incomplete stage at rupees 45 and will incur subcontracting charges of rupees 30 per unit to match it to the stage at which it receives goods from division A. So this is the point of understanding. I will make a para over here so there is a clarity. B can buy the input A from outside at a slightly incomplete stage at rupees 45 per unit. See, A is supplying to B. So B can buy it from outside also at 45 rupees and will incur subcontracting charges of 30 to match it to the stage at which it receives goods from division A. So 45 plus 30, it becomes 75, and selling price charged by division A is 70 rupees. You have seen that. Division B is willing to pay a maximum of rupees 75 per unit if division A supplies its entire demand of 45,000 units. See, this is a condition. It's always a conditional price, that we are ready to pay even 75 provided you are catering to our entire requirement of 45,000 units. Right? If division A supplies lesser quantity, then division B is willing to pay only 70 rupees per unit. I hope you understand all ifs and buts. This is what is the real life situation. This is what is real life. Straightforward, nobody will accept the given price. I am ready to pay, I am division B manager. I am ready to pay 75 rupees to division A provided they cater to my entire requirement of 45,000 units. Right? I am ready to pay only 70 rupees in case they supply any lesser quantity. I am very clear on this as division B manager. And as it is, I may get this from outside at 45 rupees in incomplete stage, incur some subcontracting charge of 30. So finally the price which I am willing to pay for this product, for this input, will come to 75 rupees. So 75 rupees is the upper bar I have kept for this transfer price as division B manager. Division A has also received a special order for 15,000 units which it needs to either accept in full or reject. So division A has also received a special order for 15,000 units which it needs to either accept in full or reject. You cannot accept in piecemeal. See, again, this is a catch, that you are always tempted by lucrative offers from outside, and these lucrative offers really tempt you. But then no supply in piecemeal. You have to supply full 15,000 units to that special customer. Division A के लिए special order आया है. Division A may choose to avoid variable selling cost of rupees 5 per unit on transfer to B, or even special order. That we have seen the difference of 10 rupees and 5 rupees, that variable selling cost is mainly for external party and internal transfer as well as special order, by incurring fixed overhead of rupees 50,000 per annum instead. So all these are ifs and buts. These are called constraints or restrictions under which every organization, every division has to operate. And that is why we say it is managing within constraints, managing under constraints. Three restrictions are there. You have seen these three restrictions. Division B manager बोलता है, I am ready to pay 75 rupees provided you supply me fully 45,000. Otherwise, I'll pay only 70 rupees. Right? Division A manager is getting a special order of 15,000 units from the market, but that cannot be divided in piecemeal. It has to be catered in totality. That means either accept in full or reject. And of course, special price, what you charge is to this special customer also. And the difference of 10 rupees and 5 rupees varies.
होतं तुझ्या ह्याला इतका
पण मग आता तू कनेक्ट केलंस का तुझं
माझं चालू आहे, आत्ता चालू केलं, माझं बंद झालं होतं,
आपोआप बंद होतं असं?
संपलं असेल युसेज. 1801 रिफ्रेश केला मी. हा घे आता वापरायला लाग.
So you have two questions which are asked based on this case. One is what is the best strategy for division A? Show the profitability of that option. What is the best strategy for division A? Show the profitability of that option. A ने क्या करना चाहिए? Should it cater to the special customer by supplying 15,000 units, or should it supply entire 45,000 units to division B? And if it supplies 45,000 to division B, it will be left with 5,000 units capacity extra. You can see this. Division A has a capacity of producing 50,000 units. समझो 45,000 division B को supply करता है, which is the requirement of division B. Still, it will be left with surplus of 5,000. That 5,000 can be sold in the market, but that 5,000 cannot be given to the special customer. This is to be kept in mind. Or you can always cater to the special customer and then don't cater to the internal customer. So what is the best strategy? Pros and cons. You have to evaluate cost-benefit analysis of different courses of action. Show the profitability of that option, which is the best strategy for division A. Question number 1. And question number 2. What will be the range of transfer price B under if the best strategy is chosen? That means, what is the best strategy for division A? If we conclude that yes, best strategy will be to reject the special order and concentrate only on internal customer, and then balance 5,000 you sell in the open market to external customer. If that is the scenario, then what is the range of transfer price B if the best strategy is to be chosen? Let us look at the approach. What is the best strategy for division A? All figures are in your mind and therefore you can apply very well. Any doubt you have, you ask me in the link. With a production capacity of 50,000 units, it's given elaborately. I told you purposely it is given in an elaborate manner so that you are able to refer to the original data, apply and then get convinced, get proper understanding. But in the exam, similar type of question you can attempt in a tabular form. You can give analysis in a tabular form as well. So long as you understand and you are able to convey this to the other person what you have understood, that is more than enough. Now, please keep this in mind. But for study purpose, everything is given in narrative form. With a production capacity of 50,000 units, division A has to find an optimum mix of cells between external cells, internal transfer to division B, and special order. So there are 3 people waiting in the queue for division A. One is external sales, second is internal transfer to division B, and third one is special order. Division B requires 45,000 units. Division A can supply entire 45,000 units to division B, for which the transfer price is rupees 75 per unit. Or it can supply lower quantity, for which transfer price is rupees 70 per unit. Both the scenarios are discussed very well. As production increases, certain cost components would also change and change to cost of production and selling expenses as discussed below. So you are given the differential cost in terms of selling expenses and cost of production. It is given that for special orders or internal transfers, division A can either bear a variable selling cost of rupees 5 per unit or choose to incur a fixed cost of rupees 50,000 per annum. That's again a choice. Division A has decided either it will bear a variable selling cost of rupees 5 for the special order and internal customer, internal transfers, or incur fixed cost of 50,000. Now working out the indifference point. All of you know point of indifference is nothing but the point at which both the costs are the same, right? It's a trade-off situation for division A. So selling cost will be the same at 10,000 units. At what point will number of units into 5 equal to 50,000? Answer is 10,000, right? 50,000 rupees is the fixed cost at how many, and the fixed cost is rupees 5. So at what point will number of units into 5 equal to 50,000? Answer is 10,000 units. Right? 5 rupees is the variable selling cost. So 50,000 is the fixed cost. So fixed cost 50 divided by 5 rupees variable selling. Generally we don't do fixed cost upon variable selling cost. This is not a formula or something. It is a matter of understanding. Please understand, we are calculating indifference point. So I am highlighting here indifference point. We are highlighting. And that indifference point comes to 10,000. At 10,000, absolutely division A is neither at profit nor at loss, because 5 rupees selling cost incur करती है तो भी 50 आता है. Fixed cost of 50,000 anyway, whether you manufacture 10,000 or otherwise. For any transfer or sale below 10,000, it makes sense to bear the variable cost of rupee 5. So one thing is clear, if your actual transfer is less than 10,000, then better to bear variable cost. If your actual transfer is more than 10,000, better to bear fixed cost. Say समझो your actual transfer is 7,000 units, then 7,000 into 5, 35,000 will be better option than 50,000. Correct? But if your transfer quantity is 11,000, then 11,000 into 5, 55,000 will be higher than 50,000. All of you are getting? If your number of units to be transferred internally is less than 10,000, say 8,000, then 8,000 into 5, 40,000 rupees is the variable selling cost. That variable selling cost 40,000 is less than 50,000 fixed cost. So obviously, if you are planning to transfer internally less than 10,000, it is the variable selling cost that will matter, or that will be more beneficial. Whereas if you are transferring anything more than 10,000 units, then fixed cost will matter. Now here, because of this discrimination or differential kind of cost structure, we are discussing all this. Otherwise, there was no need to calculate indifference point. Now, even if division A chooses to cater entirely to external sales of 30,000 units, the balance of 20,000 units will be used to cater to either special order or internal transfer to division B, or can even be both. Special order of 15,000 units and internal transfer of 5,000 units. Now look at the pros and cons. Look at these scenarios, multiple scenarios which are getting developed. I would say the last question was then straightforward, because the scenarios were well defined in the last question. Please try to recollect the last question. In the last question, it was very categorically given what is the profitability of each division and the company's profitability in current scenario. Point number 1, in today's context. Scenario 2, in case the external supplier is supplying at 47 rupees, now what is the price, what is the profitability of each division and the company? That was scenario number 2. In the last question I am talking about, the two scenarios were clearly defined. In this question, scenarios are not defined clearly. You have to bring permutations and combinations. You as students have to bring permutations and combinations, and then do the analysis of cost benefit analysis of each permutation combination, each scenario or each situation. Now that is a great challenge, rather more challenging than when the scenarios are given to you. And that is why I have chosen this question to solve now at this stage, and now in the first we solve that relatively simple question. So even if division A chooses to cater entirely to external sale of 30,000 units, समझो 30,000 पूरा market को बेचना है, then capacity is 50, so balance 20,000 it can use either entirely for internal transfer or partly for special order and partly for internal transfer. Right, etc. So special order 15,000 commit karo and internal transfer 5,000 de do. Since in any case sale will be more than 10,000 units, division A can opt to bear the fixed cost of 50,000. In any case, the fixed cost of 50,000 will have to be borne, because your production increases, sale increases to more than 10,000. Right? 30,000 you are catering to external market and balance 20,000, 15,000 to the special order and 5,000 to internal customer. All will occupy your full capacity. So fixed cost of 50,000 will have to be borne. So that is next. Since A is working at its full capacity, that is 30,000 units are produced, fixed cost is rupees 4,30,000. That would increase by 50,000 for every extra 10,000 units produced over 30,000 units. Right? Hence total fixed cost will be 5,30,000 units. Now please understand this. A is working at its full capacity. 30,000 units are produced. Look at the data. look at the data which is given in the table. Once again, you have already taken a pick, but to refer again. Beyond 30,000, presently the company has a capacity to produce 50,000 units and maximum it is selling to the external market 30,000. At 30,000, your fixed cost is 4,30,000, but it increases by 50,000 for every additional 10,000 units. That means 10,000 यूनिट आपने सेल किया तो इट विल 10,000 यूनिट्स एडिशनल ट्रांसफर किया तो फिक्स कॉस्ट विल इंक्रीज बाय 50,000. नाउ यू आर टॉकिंग अबाउट इंक्रीजिंग योर कैपेसिटी बाय 20,000. दैट मीन्स मैनेजिंग फुल कैपेसिटी ऑफ 50,000. 30,000 you sell to external customer, 20,000 you give to your internal के लिए 50,000. So additional 20,000 units के लिए 1 lakh. And therefore your fixed cost up to 30,000 is 4,30,000. 30,000 तक 4,30,000 है. Additional 10,000 के लिए 50,000 और additional 10,000 के लिए 50,000. So your fixed cost now will become 5,30,000. This is the point I was driving. So all of you understand this 4,30,000 becoming 5,30,000 in case full capacity is achieved. 5,30,000 will be the fixed cost. Please remember this when you are achieving your full capacity, when division A is working at full capacity. To arrive at the optimum mix, division A will calculate the contribution received per unit under various options. Now also all this throughout our discussion so far we were discussing various permutations, combinations, various scenarios, various case situations. Now let us tabulate all these case situations in one table and just analyze the cost and look at cost benefit analysis, the contribution margin approach. So we are now preparing statement of contribution per unit. Now there are various scenarios like this. Just all 4 scenarios are documented here. 1. External sell up to 30,000 units. You are selling externally up to 30,000 units. Market demand. Special order of 15,000 units. Transfer to B which is less than 45,000 units. And transfer to B which is 45,000 units. These are 4 scenarios. Yeah? And you can look at the contribution. This table is extremely important. And this has to click you in the exam that you have to prepare a table like this where you compare the contribution per unit at 4 different situations, right? First situation, external sell up to 30,000. Second, special order accepted 15,000. Third, transfer to B less than 45. That means B wants either full capacity, full requirement to be catered to, or they don't mind anything less than full provided they are ready to pay only lesser amount transfer price. So transfer to be at 45,000 units and less than 45. Let's look at this. Selling price for external sale will be 80 given in the question. If it is a special order, it is 70. And to internal customer for less than 45,000 units, 70. But anything you are transferring to B, 45,000 units, 75. Now this will be transferred to be 45,000 units at 75. And variable cost of manufacturing is given as 55 in all the cases. Selling and distribution cost is a differentiating factor. For external sales, selling and distribution cost will be 10 rupees. And for special order, there is no selling and distribution cost. Right? When you are transferring to B, whatever may be the quantity, there is no selling and distribution. This is incremental contribution approach we are using. So contribution earned will be 15, 15, 15 in each case, and for transfer to be 45,000 units, more contribution will be earned because the selling price here is 75, right? You are ready to pay. Division A is, division B is ready to pay full 75 rupees at 45,000 units. Extra, right? But he will pay only 70 rupees if less than 45,000 is transferred, obviously, right? And therefore, more contribution will be earned if entire quantity is supplied to division B. Hence, transfer to division B of 45,000 units yields the highest contribution. So this leaves a balanced capacity of 5,000 units with division A, whose maximum capacity is given to be 50,000 units. This is insufficient to meet the special order of 15,000 units, and hence division A will utilize the balanced 5,000 units to cater to external sales. Therefore, optimum production mix will be as under, and this is what I am highlighting. When you transfer to internal customer full 45,000 and external sales 5,000. At this stage, I take a pause and make you understand, always being a brother concern or a sister concern, first you have to always cater to your internal customer. If any internal conflict is there, that can be resolved amicably by involving top management or by having mutual discussions and deliberations between the two managers. But always as a courtesy and always as a good gesture, you should always respect the requirements of your internal customer. So division B's requirement today is 45,000 units, and that has to be fulfilled. So ideally speaking, you should transfer the entire requirement of division B, that is 45,000 units, to it. But then you are left, division A is left with a capacity of only 5,000 units, and therefore that 5,000 cannot be catered to special customer. Special customer wants it at full requirement, and otherwise the order has to be rejected. So reject the order of special customer and cater those 5,000 units by supplying it to the external customer, that is in the external market. Now by doing this, let us look at how it affects the profitability statement of division A. So I'm putting all together on one page so that you can see it at a glance. See whether you can understand these figures. Contribution from transfer to division B. 45,000 units you are transferring to division B, and that is at the rate of rupees 20. 45,000 units you are transferring at the rate of rupees 20. So your total contribution is 9 lakh rupees. Yeah? And external sales you are making 5,000 units, making contribution of 15 rupees. ये 20 रुपया और 15 रुपया हम लोगों ने ऊपर calculate किया in our table. The table of contribution where 4 situations were discussed. From there this 20 and 15 is picked up. So you make a contribution of 75,000 from external sales, and internal transfer make contribution of 9 lakh. So total contribution is 9,75,000. Fixed cost we have prepared working note. You can give here a reference of working note. Working note for calculation of 5,30,000, which is 4,30,000 original fixed cost. I am writing here in the bracket again for your understanding. 4.30 lakhs plus 1 lakh. 4.30 plus 1 lakh. 4.30 lakh is the given fixed cost at 30,000 units. Additional 10,000 के लिए 50,000. Additional 10,000 के लिए further 50,000. So 5,30,000 हो गया fixed cost. Working note ऊपर explain किया है. So 9,75,000 minus 5,30,000. Selling fixed expenses will be only 50,000. Please keep that in mind. These are fixed manufacturing cost. 5,30,000. Fixed selling costs are 50,000. Why? That also we have deliberated that any production beyond 10,000 units, any internal transfer beyond 10,000 units will attract the option of fixed cost. See, division A has made up its mind, management has made up its mind that when we are transferring internally to our division B, at that time either we will consider variable selling cost of 5 rupees or fixed cost of 50, and that is why we worked out the break-even point, the indifference point, the level of output at which division A is indifferent, whether variable selling or fixed cost doesn't make any difference, and that is why we calculated that 10,000 units, right? At 10,000, management of division A is indifferent between VC or option of VC or option of fixed selling cost, right? But beyond 10,000, then option of fixed cost is better, is preferable, and below 10,000 internal transfer, option of VC. In this case, 50,000 capacity is being utilized, and therefore we go for option of fixed cost, and therefore fixed selling cost of 50,000. See, each and every figure is justified. Each and every figure, there is a logical reasoning, logical explanation, which is given on the top in our narrative commentary. Now you understand why those narrative comments are very important. Logical reasoning is important. Somewhere by way of a footnote also you can write these, or assumptions or footnote. You can explain brief explanation, you can write this, but it is required. Just by putting this data in the table is not going to suffice. Right? A person should understand the source from where the source from which each figure has emerged, each figure has been lifted. So 5 lakh 30 breakup you understood, 430 plus 1. Selling fixed cost is 50,000. Again uske liye working note reference 2. So we have total fixed cost of 5 lakh 80 and 970 minus 580 is 3 lakh 95,000. So now this is the best strategy what it seems to be as of now, that yes, supply entire 45,000 to division B, which is its requirements, so that division B is happy and division B manager is ready to pay me for this entire 45,000 at a higher price, and that is 45, we have seen this, that is 75 rupees. पूरा 75 रुपया देने को तैयार है डिवीजन बी मैनेजर, because I am catering to his complete requirement. The moment I say I will cater less, he is ready to pay only 70 and so on. And therefore we make more contribution from supplying to our internal customer. जिससे contribution सबसे highest है, that option is the best. And therefore we went for this strategy. Which strategy is the best? This strategy is the best. Transfer to division B 45,000 units. Right, and balance 5,000 units. Of course, you cannot cater to special customer, so you cater to external market. Right, that is what is the best strategy. And we have seen the cost impact, the profit impact of this strategy, the course of action. So profit will be 3,95,000. That will be the profit that will be earned. I am putting it bold also. And this is the best strategy. Now, what is the range of transfer price under the best strategy? Now, whenever the question is asked on price range, you remember the formula. Always you have to write this expression. Minimum transfer price is from the point of view of selling division. I repeat, minimum transfer price is from the point of view of selling division, and maximum transfer price is from the point of view of buying division. Okay, so minimum transfer price, the selling division will recover is its marginal cost, and of course additional cost if any, marginal cost, additional cost if any, which are specifically incurred for a particular customer, plus the opportunity cost. And opportunity cost is to be recovered only if the plant is operating at its full capacity. Yesterday one student has asked, do we need to charge opportunity cost every time? No. While calculating minimum selling price, we add opportunity cost only if the hands are full. Remember my words, only if the plant capacity is fully being utilized. Right, then you charge opportunity cost. Whenever there is a surplus capacity, excess capacity, idle capacity, somewhere you note down surplus capacity, excess capacity, idle capacity, do not recover your opportunity cost. It's a thumb rule or a basic rule and a logical understanding why we are doing like this. So minimum transfer price, we write the expression. In this case, of course, we are using full capacity. 50,000 units means operating at full capacity. So opportunity cost also has to be recovered. So as discussed above, additional outlay would be fixed selling cost of rupees 50,000 that it chooses to incur rather than incurring variable cost of 5 rupees per unit spread over 45,000 units. Thus, per unit cost would be 1.11. Now, this is something which is a derived figure, and therefore the bifurcation is given. 1.11 kaise aaya? You are incurring additional fixed selling cost of 50,000 rupees. Additional outlay. Normal case mein khali marginal cost you recover and opportunity cost. And additional cost is recovered only if it is specific, peculiar to a particular customer. Only if that cost is specific, peculiar to a particular customer. Then only you recover additional cost. Now, in this case, the division A has opted for fixed selling cost of 50,000, and therefore that is spreaded over 45,000 units, because 50,000 will be charged to 45,000 units only. Special cost, special fixed selling cost. So 50,000 upon 45,000 is 1.11. Still, for your better understanding, I am writing this 50,000 divided by 45,000. You can understand this calculation. 1.11 is the additional outlay. Had division A not sold 45,000 units to division B, it would be chosen from any of the other options. Namely, that is what is given. Selling 30,000 units externally, meeting the special order of 15,000 units, or transfer of less than 45,000 units to division B. See, now we are working out opportunity cost, and for opportunity cost purpose, we need to do these deliberations. हम लोगों ने दो चीज already find out की है. We have calculated marginal cost that is given in the question, and that is 55 rupees. minimum transfer price that division A will demand is variable cost or marginal cost 55, that we have already understood, that is given in the question. Then 1.11 we have already calculated, just now, that is 50,000 fixed cost, selling cost over 45,000. Now the important question is calculation of this. So I am putting a circle over this. This is what we are deliberating now. Opportunity cost. How did we work out the opportunity cost? That is a question mark. That is a question mark. And for this, the discussion is going on. How this opportunity cost has been worked out. We always think in the negative way, the other way. Had this not been sold to division B, what would have happened? Had division A not sold 45,000 units to division B, then it would be chosen from any of the other options. तो क्या करते थे? 30,000 units in the external market. समझो division B को 45,000 unit बेचना ही नहीं है. Then 30,000 units you will cater to the external market and 15,000 की special order pending है. So 15,000 special order you will need or transfer less than 45,000 units to division B. So these are the two scenarios. I repeat that or is there. So this or I distinguish. I am highlighting the word or. Or please understand this is an option. Look at this most important paragraph. Had division A not sold 45,000 units to division B, it would have either sold 30,000 units externally and special order of 15 and है, इधर बीच में and है. Selling 30,000 externally and meeting special order of 15 or transferring less than 45,000 to division B. In either case, it would have earned contribution of at least 15 rupees. Because in all three scenarios, situation analysis, what we have done on the top, in those 4 columns, in all 3 cases, it comes to 15 rupees. Only in the last case, the contribution came to 20 rupees. So this may not have been the best strategy for division A, but would have been yielded at least 15 rupees contribution. Today, the best strategy is selling 45,000 units to internal customer and balance 5,000 to external customer and reject the special order. That is the best strategy. But had this not been the best strategy, then the next best strategy would have been either of the above. So either of those above 3 columns which are there, all 3 columns show the contribution earned of 15 rupees. So at least 15 रुपया contribution per unit मिलता था. So this is the opportunity cost of division A for choosing the best strategy. So when you say that you are choosing the best strategy of supplying 45,000 units to division B and 5,000 to external market, you are deprived of 15 rupees contribution from other 3 options. So what division A is deprived of is an opportunity cost of best strategy. Now you all are finance students, so in costing always we have this opportunity cost concept which you have been learning right from intermediate. So ये नहीं करता था तो वो होता था. So had I not catered to my internal customer their 100% of their requirement, then either I would have catered part of their requirement or none of their requirement and sold 30,000 in the market and special order. Right? In either case, I would have earned at least a contribution of 15 rupees. I am deprived of that contribution. So that is an opportunity cost. So that also explained. And by the way, coincidentally, it is coming to 15 rupees in all other 3 scenarios. Right? Had it been something else, then we would have to think on a different lines. For example, I will take your attention back to that table where 15 rupees is worked out. So that table, now you understand how important is this table. Yeah? Where everywhere 15 is highlighted. 15, 15, 20. I'll highlight these 4 figures also. You are simultaneously looking at your module because this is a question from the module. And it is given in the form of an illustrative question to highlight various scenarios and how the conflicts take place in the minds of the management. Ye karu ya wo karu, is far, us far. This kind of situation always we encounter in our real life. And that time we have to take decisions based on cost analysis. So 15, 15, 15, 15. In all 3 scenarios it is 15. आपने पूरे 30,000 एक्सटर्नल मार्केट में बेचे तो भी 15, स्पेशल ऑर्डर केटर किया तो भी 15, लेस देन 45,000 सप्लाई टू योर इंटरनल कस्टमर फिर भी 15. So in all three cases the contribution that would have been earned is 15,000 which you are now deprived of, so that is an opportunity cost, right? So on one hand, by catering entire requirement of internal customer, you are making good amount of profit, and that is 3,95,000. But while deciding the price range, minimum price particularly, we use that expression. So I hope all of you have no questions on this. Minimum transfer price is 71.11 rupees. This is the answer. Minimum transfer price is 71.11. And maximum transfer price which division B is willing to pay, that is given in the question, 75. Division B ने कभी मना किया ही नहीं. Division B हमेशा बोलते रहे we will pay 75 rupees per unit provided you cater to our requirement fully. No partial fulfillment of our requirement. 100% fulfillment of our requirement. देना है तो पूरे 45,000 units दे दो. We are ready to pay you higher sum, 75 rupees. So anyway, they have mentally reconciled that the maximum price, transfer price, which they are willing to pay is 75. Our price range is already determined. Minimum price is 71.11 and maximum transfer price is 75 rupees. So this would be the range in which transfer price will be negotiated. So transfer price always vitiates between the range and minimum and maximum. Minimum is 71.11 and maximum is 75. So in case of conflict, always management is required to do a proper analysis of the cost and based on that take the decision. Now we will summarize the learning points out of this case. Both the cases which we discussed in today's class were very important. One case, as I said, the earlier case prior to break was November 19 question in the exam and very tricky question, but still it is simpler as compared to this module question, because in this question, case study number 2 which we looked at just now, module question did not specify the scenarios. You as students were asked to list down various scenarios. ये बहुत मुश्किल होता है. Listing down the scenarios is very difficult. More difficult than when the scenarios are given readily in the question paper. So when question paper says these are the scenarios, scenario 1, 2, 3, I know I have to do cost benefit analysis in each scenario. But here scenarios themselves are not given. You have to do the struggling of various permutations combination, and therefore according to me this question is more challenging than the earlier case study. But both the case studies what we discussed in today's class were extremely important from the point of view of decision making, particularly when there is a conflict between the two divisional managers and when the top management has to intervene, reaching the concept of reaching the objective of goal congruence. Right? And while the summary or the learning point or the outcome of this case is, whenever there is a conflict, top management should resolve the conflict. So because it wants to achieve the objective of goal congruence, it doesn't want to dissatisfy any of the managers. Both the managers are equally important. The selling division and the buying division, both are his right hand, left hand, and he would not like to compromise or lose on any of his operating managers. Both are performing well. He would like to motivate them, both of them, and therefore he will reach to a situation where there is win-win strategy that is adopted. So always any decision in transfer pricing must lead to win-win situation for both the transferring division and transferee division. Now, about the excess demand, excess capacity, we will take down this. So you also are expected to write in a separate note learning outcomes out of this. So every time we jot down the learning outcome, so now you take down the learning outcome out of today's class. When a plant is operating at full capacity of the plant, yes, tell me, will you recover opportunity cost or not? Of course, yes. When plant is operating at full capacity, recover opportunity cost. Recover opportunity cost. In minimum transfer price, minimum TP transfer price, minimum transfer price that is determined. minimum transfer price that is being determined. These are all common sense understanding, but still if it is documented, it is registered in front of you in your mind. If plant is operating at full capacity, recover opportunity cost in while deciding minimum transfer price. So when minimum transfer price is being determined, recover the opportunity cost. So formula becomes variable cost or marginal cost plus specific cost, if any, to cater to the specific requirement of the customer plus the opportunity cost. And when there is a excess capacity, I will write all parallel words, or surplus capacity or idle capacity, all one and the same. Excess capacity, surplus capacity or idle capacity. Do not recover opportunity cost. Recover only variable cost. Recover only marginal cost. As it is, you are setting freely. There is no demand for your product in the market. As it is, the product is not much in requirement in the market. So what to do with your idle capacity? At least cater to the internal customer. Keep your internal customer happy by making internal transfers at a price whereby you recover only marginal cost or recover only variable cost. Recover only marginal cost and don't charge opportunity cost. Simple. I hope this I wrote because there were two queries on same lines asked by two separate students. Don't recover opportunity cost. These are the learnings, and of course the second learning is when you are charging to your internal customer, selling and distribution overheads are not to be charged. S&D, I write S&D, selling and distribution cost, not charged, generally not charged to internal customer, because the supplying division is not promoting any brand by selling to the internal customer. There is no question of incurring any selling and distribution expenses, marketing expenses when you are supplying to the internal customer. So there is no question of recovering any selling and distribution cost from internal customer. This is another point you have to keep in mind. Of course, the generic point which I have highlighted in the last case study also and today's two case studies also, whenever there is a conflict between the two divisions, ultimately both the divisions should resolve the conflict. Here are the things. These words will come in your answer when you are doing the qualitative comments, and that is goal congruence, win-win situation for both the divisions, discussed in the last class. Again, I am emphasizing, and next class also I will emphasize, because these terms have to be there in your answer in analytical comments or narrative comments, particularly when you are giving your expert views, recommendations, etc. Answering a theory part of the case study. So goal congruence for the organization, win-win situation for both the divisions, optimal transfer price should be fair, transparent and competitive, keeping in mind the market price prevailing for similar type of products. Decision making has to be optimal and not suboptimal. So the moment one of the divisions stops catering to the internal requirement of the internal customer, then that internal customer, that purchasing division may buy from the external market, and it may turn out to be a suboptimal decision. We saw that in the last case, not this case, but the last case where 47 rupees were paid extra rather than 30 rupees manufacturing cost. So internal evaluation, generally transfer pricing is used as an internal evaluation tool. It is for divisional performance measurement tool. That is how we conclude. We say it is not to be reported anywhere, but somewhere our internal conflict we have to resolve internally. Conflict between two divisional managers to be avoided, and if there is any conflict, there is intervention by the top management in the interest of the company as a whole. These are the practical applications in business decision making. Those who could not listen to my earlier session, now once again are at par with others. This is what I discussed in the earlier session also as summing up points from the case study analysis on transfer pricing. I will quickly look at the questions, if any. Give me a minute. Just stay connected. I will look at the question. I read this. I read the query just now of the students. Okay. Now it's okay. So, can I continue? No, it's over. I want to speak now. Can I speak? Right? Am I right? Okay. So I looked at the query just now. Post break, there was only one query on this case. So since there was no interruption of any network connection, obviously all have understood this case rate very nicely. This particular case study which we took after the break, there were no academic questions on this case. But of course, one of the students has again asked repeatedly the same question, and that is, sir, will you share the Word document file or the PPTs of this? There is no PPT. This is the Word document file where everything. This is like a slate or a whiteboard. So you can see the Word document file. It is like a whiteboard or like a slate. So I have saved everything what I have been writing from time to time on this slate or the whiteboard, and along with that, the Word document containing the case study. It is the same file which contains case studies, the approaches, that is the solution, and also the learning points or learning outcomes from the discussion of the case. Everything is in one file, Word document. I told my dear student that yes, once the topic is completed, we have one more session on transfer pricing in Sunday's class. So once we complete all the case studies on transfer pricing, again in Sunday's class, we will take around 2 or 3 case studies. So once we are through with this chapter, as a consolidated file for both the topics which I have covered, topic number 1, performance measurement and evaluation, and topic number 2, divisional transfer price. That is chapter number 9, 8 and chapter number 9. Both the chapters, case studies based on both the chapters, I will be sharing with all of you through our technical team. So don't worry, all of you, those who have been attending the sessions or have been listening, you all will get the files. Absolutely no problem. Then probably once again you sit. I told this immediately after the break also, that once again you sit with the recorded voice of mine, that is the downloaded file from the downloaded video from the YouTube, and you map with the original case study data and the approach. That mapping will have to be done. 3 things are to be mapped: the original data from the case study, the approach, and my voice. All 3 things will have to be mapped. And of course they will be shared, but just have patience for one more day. Let Sunday's class get over on transfer pricing, then consolidated I will be sending this across to you through the technical team. So thank you friends, we have finished our today's session. We meet again on Sunday for another round of 2 or 3 case studies. Again, thought-provoking or brainstorming case studies. I always say those case studies on transfer pricing are very interesting, thought-provoking, brainstorming, but when it comes to analysis of the case from the point of view of students, it is really a challenge. Just to read the case and understand the approach is one part, which is very easy at a final CA level, but analyzing the case by oneself, by yourself, and that too during examination, during those 3 hours, without losing on any single point. So that connecting the dots, what we say, that is the case study on transfer pricing. Connecting the dots. Data is all scattered. If you miss out any of the thread, any of the link in any of these data, then there are chances of making mistakes in evaluation of the case and thereby the final decision. Final decision making can also go wrong. Complete case study may go out of your control. And for that reason, repeatedly I have been saying in this paper, particularly which is predominantly case study based paper, you have to read every case study minutely once, twice, thrice till the time you are satisfied. And by highlighting certain key points in the case, underlining certain key figures in the case, reading between the lines, that is necessary. That kind of practice by referring to case studies in the same manner from various other resource material of our BOS will give you that confidence. If you refer to BOS material which is there on the knowledge portal and refer to the case study, the exam hall, you are able to analyze the case and interpret the data. I will close over here my session for the day and will meet again with additional 2-3 case studies in the next class. Thank you very much.